This is a market where the growth data is now in the driver's seat.
This is an environment where the Fed can start removing policy restrictiveness.
It could take a long time to get to neutral.
If Godot didn't arrive here over the last really 18, 24 months, why should Godot arrive in August of 2024?
It's never about what the Fed should do, it's what the Fed is going to do.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday with stocks within 1% of all-time highs on the S&P 500. Your scores look like this. Equity futures pushing higher by 0.05%, slightly in positive territory on the Nasdaq, slightly into negative territory on the Russell. After some outperformance in yesterday's session, the small caps down by 0.2%. Your day ahead shaping up as follows. The annual Fed get-together kicking off in Jackson Hole, Wyoming. We'll catch up with the Kansas City Fed around about 7:30 Eastern time. We'll bring you some of that conversation. A sprinkle of politics, as always. The headline act a little bit later on this afternoon, this evening, will be the Vice President Kamala Harris. But the main event, I think, for financial markets, 8:30 Eastern time. Initial jobless claims. It is Jobless Claims Thursday. And Danny Berger, as you know, jobless claims has taken on a lot more importance over the last few weeks.
It certainly has, because jobless claims was the thing that essentially saved us. It was the thing that flipped us from saying we are heading off a cliff to everything is okay. The jobless claims numbers have come in remarkably resilient. Despite the fact we got that huge jobs revisions yesterday that essentially was used as a Rorschach test that everyone decided to read it how they want, jobless claims, because it has been trending in a very constructive way. If it breaks the trend today, that could be bad, or it could just reinforce that, hey, everything's okay, the rally can continue.
So last week's number was 227. Just to give you an idea of the estimate today in our survey, the median estimate is 232. Danny also mentioned that massive revision we saw to a year's worth of payroll. So let's talk about some numbers. From April 23 to March 24, payrolls grew by about 170k a month. That was down from the previous estimate of about 240 a month. I'm hearing from the likes of Bank of America's Mike Gape and Danny that it's solid. It might not be strong, but it's still solid, and this is okay.
But again, everybody came into this with their own lens and took away from it what they wanted to. Bank of America might say it's solid, but someone like Neil Dutta looked at this and said it shows that the job market has been weaker for a while now, and the Fed and Powell is even more behind. And then you have someone like Goldman's that says it actually overstates the true number, that they think this will be revised again, and sure, the downside was only 300,000. Or if you're a government conspiracy theorist, there was plenty for you in that report too.
Plenty, and plenty about the release as well that we'll talk a little bit about a little bit later in about 28 minutes time. We need to talk about the release, why it took so long and why some banks were just able to pick up the phone, dial a number and get the number themselves. We've got some questions about that. I've got some questions about whether we go 25 or 50 in September. Steve Englander of Standard Chartered had this to say about the minutes, which were incredibly dovish. And if you missed the minutes yesterday afternoon, essentially several officials were ready to go in July apparently, and the vast majority are ready to go in September if incoming data comes in line with their expectations. Steve Englander has this to say: it's hard for me to see why they would issue minutes with this tone if Powell is going to wrong foot the market in less than 2 days by being hawkish relative to market pricing. And he thinks the door is still open for this Fed, Danny, to go 50.
Well, I guess what does Powell gain by pushing back on this market? He essentially removes optionality, and we know that's something he wants, especially because they're looking at so many data points coming up, like the next labor report. The only thing I would say, John, is if you listen to Powell in the last presser, he was specifically asked by a journalist, how are you thinking about 50 basis points of cuts? His response, it's not something we're thinking about right now. And central banks tend to hate to admit errors, and essentially going by 50 after the last presser saying that they're not even thinking about it might in some ways be admitting an error.
Did you notice there was a bit of daylight between what Chairman Powell was saying in the news conference and what we actually saw in the minutes? Just a bit of daylight. And I have to say, I've wondered a few times, is Chairman Powell just doing a poor job of reflecting the consensus on the committee in the news conference, or are they just massaging the minutes? Are they shifting the emphasis in the minutes to catch up with recent information?
I was going to say, I've heard this argument before, and even as it relates to the jobs revision, like, hey, don't be distracted by jobs revision. That isn't the real revision going on. The revision is the Fed minutes, that they want to make it match more what the market is saying, or they just want to make it seem like they're not behind. I don't know. I'm not certain of that, but that argument certainly exists just because you do see the discrepancy of a Powell, again, who is talking about, we're not giving us a firm deadline if they are going to cut in September, yet the minute saying people are discussing July. That is a big difference.
There's another disconnect I think we need to sit on this morning too over the next 3 hours or so. BMO's Ian Lincoln picked up on this. The market expectations, soft landing hopes funded by hard landing rate cuts. How problematic is that? This is what Ian Lincoln had to say. It's striking that the outlook has quickly dimmed to the point of once again pricing in more than 100 basis points of cuts by year end in the absence of a tangible breakdown in the labour market. Do you think this market is set up dreaming about a soft landing but funded by the kind of rate cuts that would typically be associated with a hard landing?
Okay, so the argument you could make in the benefit of the market is that we've already had the soft landing and now you just need to support it. And in order to support it, you need something that looks like neutral, which, again, none of us know what neutral is. But if it's something like 3.5% and the Fed cuts 25 basis points in every single meeting, it won't be until June that they would get to 3.5%. That's nearly an entire year that it would take to get to neutral. So one of the arguments is that it's essentially just preserving the soft landing by doing recession-like cuts, because you need to get to neutral quickly before a soft landing turns into a hard landing.
Chairman Powell's address tomorrow morning. We'll try and make sense of all of that. And then we've got a job print September 6th, a CPI print September 11th, and a week later you've got that Federal Reserve decision on September 18th. The scores going into all of that. If you're just joining us, welcome to the programme. Equity futures on the S&P 500 positive by about 0.1%. Yields a little bit higher by a single basis point, the 10-year 381.61, and the euro a little weaker. We'll talk about the Eurozone PMIs later in the hour. Better than expected, but France doing the heavy lifting with the Olympics going on, and a fear that maybe that's going to fade as we work our way out the other side of summer. Euro dollar 111.37. Coming up this hour, our lineup looks like this. Steve Chiavarone of Federated Hermes on the warning signs he sees for the US economy. Anne-Marie with the latest from the DNC ahead of Harris's keynote address later this evening. And Tom McLoughlin of UBS assessing the impact of the US election on financial markets. We begin with our top story. Stocks heading steady with the focus squarely on Jackson Hole as the Fed's annual get-together kicks off. Steve Chiavarone of Federated Hermes writing the following. While we remain overweight stocks and expect only a modest slowing of the economy and measured Fed rate cuts starting in September, we do note some warning signs. Steve joins us now for more. Steve, good to see you. Last time we spoke, you used this word fine. You said growth was fine, inflation was fine, earnings were fine. That was the start of summer. Where are we now? Is everything still just fine?
Well, I think it is still fine. And again, we expect growth to slow a bit, not a ton. And we expect the Fed to start rate cuts, but in a measured pace. So, when we think about rate cuts, we're thinking one a quarter for 8 quarters, not one a meeting. And I think that's quite different than what the market's pricing in. But the warning signs, John, are, forget about the labor revisions yesterday. The unemployment rate's up 0.9% from its cycle low. Now, historically, whenever that's happened, you were already in a recession. Now, we don't think we are today. Look, a lot of that has to do with this big surge in the labor force. A lot of that has to do with really southern border crossings and the number of non-U.S. foreign participants in the labor force. But that has to warrant your attention. You've got a yield curve that's uninverting. That historically is a big warning sign as well. And then, finally, the political uncertainty is much greater now than it was just a couple of months ago when you had 2 essentially incumbents in office. Whereas now you've got one candidate with a set of policies that's, less certain. And so you look at those 3 things together, and I think they all warrant attention, especially with the market trading at an all-time high here.
Well, let's pick out those 3 things again, Steve. So a relatively sharp increase in unemployment, the disinversion of the yield curve, which we typically associate with the onset, the beginning of a recession. And the third point, just the political uncertainty on the horizon. When you put all that together, Steve, is that reason to pull back, to de-risk just for a number of months? Is that what you're doing?
Well, it certainly was on the growth side. Growth stocks are trading, still are trading above 30 times. They really only did that during the pandemic and the great financial crisis. And we thought a lot of good news was priced in. If you look at that disinversion of the yield curve, what's happening is the short rates we expect to come down. Let's call it a couple hundred basis points over the next couple of years. But we think that the long bond is about fairly valued, maybe even a little expensive here. We think about a 2.5% long-term inflation rate, 50 basis point real rate, 100 basis point term premium. That's about a 4% treasury. So we think companies that are funding short, we think companies that require a steeper yield curve are the ones that are going to do best. And those are things like small caps. Those are things like financials. Those are things like value names. And there we still feel very good because they're trading at reasonable valuations and they're starting to assume the leadership in earnings growth. But for big tech and growth, we think things have been as good as they can be and they're getting less good.
Steve, though there are warning signs, as you point out. So how do you basically get your head around this idea that a steepening yield curve would be better for small caps, cyclicals, value stocks, but a weakening economy wouldn't necessarily be good for them?
No, it's a great question. It's why the mosaic has to come together, and it's important. If we thought that there was a recession on the horizon, you would not like those parts of the market. But if you're just seeing a modest slowing, then that's okay, particularly if it's a modest slowing in the context of rate cuts, right? Whether or not the Fed goes 50 or 25 or does, 50 basis points of cuts this year or 100, you pick the number. We think what's more important is that there's a couple hundred basis points of cuts coming over the next 12 to 24 months. We think it's more like 24, but whatever. It's still 200 basis points coming. And that absolutely helps small caps that have a lot more variable rate debt. And it absolutely helps companies that are shorter duration, like value names, as opposed to the longer duration growth names. And so I think when you look at an economy that's slowing but staying okay, fine, if you will, John, rate cuts that are coming, you put all that together, that's pretty good for those parts of the market.
One thing I didn't hear you say, Steve, is momentum, and that had been the trade before the August 5th turmoil. Is it fair to say that these momentum, growthy, type frothy names, that's not the trade anymore? Are you basically saying not only are those small caps and value stocks going to do well, but they're going to take over the leadership of this market?
Yes, that's exactly what we're saying. And we put where our mouth was. We added 3 to 4 points to large cap growth last October on the lows, or near the lows, maybe not quite on the lows, but near the lows. And those names were up 50% from when we bought them, back in last October, trading over 30 times, again, against the backdrop of rate cuts that should benefit different parts of the market. When you look at relative earnings growth, Mag 7 was growing 50% year over year at the beginning of this year. By the end of this year, we think that's going to be something closer to 15%. While, let's call it the forgotten 493, their earnings were declining 5% at the beginning of the year, and we think they're going to be up 20 by the end of the year. So with that kind of handoff, with the rate cut regime changing, with the nature of the way that the yield curve is uninverting, we think all of that creates new leadership.
Steve, that's where the market's going. We've seen that recently. Equal weight S&P 500, again, all-time highs at a close yesterday. Small cap with clear leadership and outperformance in yesterday's session. Steve, I just wonder if we're underpricing event risk in early September 6th to be precise, when we get that payrolls report, and whether we could be having the same conversation we were having only 2 weeks ago.
John, as usual, you and I are on the same page. We had a meeting with our macro committee just a week ago to talk about all the things that concerned us and all the things that comforted us. And, in 4 pages of notes across that discussion, I think the word inflation came up once. A third of the document was about jobs and the labor market. And this is before the revision. I think that September 6th really is going to help determine the path of Fed rate cuts. If that's a strong number, if that's a decent kind of in line to better than consensus number, somewhere around that 150,000 job level, then I think the Fed's really going to try to guide to 25 basis points in September and try to get the market comfortable with 1 cut per quarter. If, however, that number's soft, then the Fed will be forced to kind of come to the realization that they are in fact behind the curve. And then I think you're in the realm of 50 basis points. And so I think when you think about that balance of risks, and the Fed's talked about this, in a balance of risks that were almost exclusively tilted towards the inflation side, I think now it's the jobs market that's key. And we talked about claims, or you were talking about claims before I came on. It's important that those claims stay between 200 and 250,000. If they break into a 250 to 300,000 range, then I think you are in a much more aggressive Fed cut world, and one where you're a lot more worried about the labor market. We're not there yet, but that's why I'm saying it's a warning sign. It's a yellow light. It's not a red light yet.
Steve, I just wonder about these warning signs, be it jobs, be it disinversion of the yield curve, be it the Somme rule triggered. Since World War II, we've only had 11 recessions. That's not exactly a lot of data to work with or get anything statistically significant. So when the lights are flashing, the yellows and maybe even some of the reds, how much faith can you actually put in them?
less. Like I said earlier, there's 11 times since World War II that you've had an unemployment rate up 0.9%, and every time you were already in a recession and it kept going higher. And so you would look at that, and I think a lot of analysts made that mistake over the last couple of years, looking at these kinds of recession signals and then having very high conviction about impending doom, only to be proven that it was in fact a little bit different this time, at least so far. I think this could be another one of those examples. Yes, the unemployment rate's up, but the economy has added 2 million jobs during that period. And again, if you look at the U.S.-born labor force, that might be down. It's really this increase in non-U.S.-born workers. Now that, again, I'm not trying to make a political comment on that. I'm just saying that's different. You haven't had that kind of border policy. You haven't had that kind of immigration in these past examples. So that's why it's a yellow. That's why it's not a red. It says, okay, this is enough of a deterioration in the labor force that it warrants my attention. I might want to be a little bit more worried about valuation in certain areas. And maybe I pull back the size of an equity overweight, but I'm still overweight, right? We're still 3% overweight, which is 30% of our max. We still think that the base case is a slower but not careening lower economy. But I wake up and I look at that labor market data a little bit closer than I used to be, and I'm going to be slightly less patient.
It's made people nervous, jittery over the last few weeks, that's for sure. Steve, it's going to catch up and get your views. An update from Steve Chiavarone of Federated Hermes. So this is what the calendar looks like. 8:30 Eastern time, 2 hours and about 15 minutes away. We get another read on jobless claims. And jobless claims over the last few weeks has been pretty contained. The previous week, 227. We're looking for about 232k later on this morning. What you heard there from Steve Chiavarone, just the hope that that remains contained sub 250, and that's the hope again this morning.
Right, because we can live with the yellow flashes, right? We can do okay with that. Risk can continue to rally. Small caps can do well because it means we're getting cuts in an environment that's still consistent with an okay economy. If the labor market turns, I think that's when things need to start to reprice. The bond market will go from pricing, I don't know what it is, 20% odds of a 50 basis point, maybe to fully pricing it in. And the equity market, you'd have to argue, is incredibly offsides if that is the case, considering we keep getting closer and closer to a record, considering an equal weighted measure of the S&P is at another record. So I don't know, it might be a scary prospect if it does start to weaken.
Within 1% of all-time highs on a market cap weighted S&P 500 this morning. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Yahira Hekes. Hey, Yahira.
Hi, John. Italian search and rescue teams have recovered a fifth body from a sunken yacht off the coast of Sicily, where British entrepreneur Mike Lynch and Morgan Stanley International Chair Jonathan Bloomer are feared dead. Search and rescue crews are continuing their fourth day of efforts. The yacht was hit by a tornado near Porticello, Italy on Monday. Authorities haven't yet released any statements confirming the identity of those recovered from the wreck. Meanwhile, the Paramount merger saga continues. Sources telling Bloomberg Edgar Bronfman Jr. has raised his offer to take over Paramount Global to $6 billion. That tops the $4.3 billion bid he made just 2 days ago, in a move that could upset Paramount's plan to merge with Skydance Media, led by David Ellison. That deal includes a 45-day period in which Paramount can review other offers. Bronfman, the media executive and Seagram heir, is reportedly expected to argue his proposal will result in less dilution for some shareholders. And Walt Disney has appointed former Morgan Stanley CEO James Gorman to lead the search for a successor to CEO Bob Iger. Gorman joined Disney's board this year and oversaw succession at Morgan Stanley, where he continues to serve as executive chairman. Disney is weighing both internal and external candidates to succeed Iger. His second term as CEO runs through 2026. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. More from Yahira in about 30 minutes' time. Up next on the program, politics gets personal.
You know, when I was teaching, every year we'd elect a student body president. And you know what? Those teenagers could teach Donald Trump a hell of a lot about what a leader is.
You know, they always say, sure, please stick to policy, don't get personal. And yet they're getting personal all night long.
That conversation up next. Anne-Marie live from the DNC in Chicago after the commercial break. From New York City this morning, good morning. live from New York City. Welcome to the program. Your scores look like this on the S&P 500. No drama, up by 0.1% on the S&P, and the bond market yields a little bit higher by a basis point or two on a 10-year, 381.99. Under surveillance this morning, politics gets personal.
You know, when I was teaching, every year we'd elect a student body president. And you know what? Those teenagers could teach Donald Trump a hell of a lot about what a leader is. Leaders don't spend all day insulting people and blaming others.
You know, they always say, sure, please stick to policy, don't get personal. And yet they're getting personal all night long, these people. Do I still have to stick to policy?
Here's the latest, the final day of the DNC kicking off. Vice President Kamala Harris taking the stage this evening to formally accept the Democratic nomination and deliver the keynote address. Donald Trump continuing his counter-programming campaign. Trump in North Carolina yesterday, delivering his first outdoor rally following an assassination attempt on his life last month. Trump now heading to the US-Mexico border in Arizona, looking to attack Harris on immigration. Anne-Marie joins us now from the DNC. Anne-Marie, I'm channeling Bramo, who's making her way to Jackson Hole, Wyoming, and she'd be saying, can we please make this about the policy and get away from the personal? Can we make about the policy at the DNC? What are the policies coming out of that convention?
Well, we're going to hear from Kamala Harris tonight, Jonathan, when she gets on that stage and formally accepts the party's nomination to be the top of the ticket, to be the president. 180 basically degree reversal from where we were just a month ago when Biden was the top of the ticket. So that is why we're still waiting to hear a lot about her policy proposals. I actually sat down with some members of her team yesterday, and a lot of questions I was trying to dig into, whether it was the economy or foreign policy, immigration. I got a lot of, I don't want to get ahead of the vice president. We heard last week from her when it came to the economy. Potentially we'll see her build that out. They want to lean into this because they know the cost of living is top of mind of American voters. But I would say tonight it's going to be a lot about rhetoric, a lot about personality, and a little bit light on the details. I go back to what Libby Cantrell told you yesterday. If this is about personality and vibes, Kamala Harris could win it. If it's about policy, potentially Donald Trump could win it. I will note, though, there was a shift at this DNC, definitely compared to past DNCs when it comes to immigration, to the right for this Democratic Party. Tom Suozzi got up on the stage yesterday. This is an individual who was able to flip his district on Long Island from red to blue and said the border is broken. We heard from Connecticut Senator Chris Murphy talking about the fact this is the individual that worked with James Lankford to write that bipartisan immigration bill, and said the bill would have been passed if it were not for Donald Trump killing it because he wants the issue. And today Trump is going to have that issue, Jonathan, when he goes down to the southern border to Arizona.
I was going to say, Anne-Marie, usually the opposing party during national conventions are kind of quiet because they understand the media's attention is squarely on that. How has Trump's success been in cutting through that with the swing state tours he's going on and, as you point out, now heading to the border?
Well, he's going on a number of these rallies to a number of these states that he needs to win, notably yesterday, North Carolina, which is now seen as a toss-up. That is a state Republicans need to win. Obama won it in 2008. Before that, no Democrat had carried that state since 1976. So I actually think it's notable he's in North Carolina, spending a lot of time and capital there, instead of potentially could have been using that time in Pennsylvania or another border state. He's trying to go after Kamala Harris on the issues, but Trump is at times unable to help himself and also make this personal. Yesterday, calling her Comrade Kamala, trying to say that she is a communist, calling her the border czar, saying that she's failed on border policies, instead of really going after some of the data around the issues, which his campaign desperately wants him to do.
Anne-Marie, thank you. Appreciate the update. We'll catch up with MH with some select guests a little bit later on this morning. It's pretty obvious why the campaign wants the former president to focus on the issues. The top two issues in this country right now in this election, the economy and immigration. On those two issues, the Democrats poll very poorly relative to Republicans on those two issues, which is why those issues should be top of mind for Republicans as they campaign. Coming up on this program, we'll catch up with Bloomberg's Craig Trudell as Ford changes course on the company's EV strategy. That conversation just around the corner, with equity futures positive by about 0.1%. You're watching Bloomberg TV. Stocks doing okay on the S&P 500, positive by 0.1%. Likewise on Nasdaq 100 futures. On the S&P 500 yesterday, a close back through 5,600, an all-time high again on the equal-weighted S&P 500. And unlike this morning, underperformance on the small caps on the session today. Yesterday, outperformance on the Russell. This came from Laurie Calvasina over at RBC. We end the summer of 24 with increased conviction that August 5th was the low in the recent pullback, even if we get some choppiness, Danny. RBC saying it's likely there to be greeting us at the end will be a 5,700 price on the S&P 500. They're feeling good about it.
The wall of worry we climbed is remarkable, and not even just how far we had to go, but the pace of how we had to do it and what has been rallying. I think this is the most remarkable part of it, is it's not just big tech comes back, which it largely has, but it's the breadth of it. It's an equal weighted measure of the S&P 500 going to new highs. It's the fact that defensive cyclicals, all of them are sort of rallying together. And if you go back to before August 5th, there was this idea that it was only the large caps that were bringing us to new gains. Now it's everything. So maybe something has changed. Maybe it's, dare I say, more healthy.
Participation's improved, which undoubtedly some people might say is healthy. But what are we looking for? We're looking for growth to hold up. OK, solid but not strong. We can cope with that. Maybe a deceleration from here, but no real downturn. At the same time, we want all of these rate cuts. Now, that kind of disconnect. Christian Mamani of Lafayette College was talking about this yesterday. Are we looking for a soft landing funded by rate cuts typically associated with a hard landing?
And this is the problem, is that the Fed has been talking about going slow, and they tend to go slow until something forces them. So the question this time around, will something force them to go faster, to do 50 basis points of cuts in multiple meetings? And what does it mean for this equity market if it is? It's this disconnect between equity markets and bond markets that so many people have talked about. But again, there is this argument that they maybe have to go fast just to get to something that looks like neutral.
Well, let's check in on the bond market, and then we can turn to foreign exchange, because there's lots to talk about there. In fixed income at the moment, at the front end of the curve, we're up by 2 or 3 basis points, 395.93. On a 10-year, we're up by about 2 basis points to 382. Just to check in on a 30-year maturity for you, just a little north of 4%, 4.1%, just to round that up for you. If you switch at the board, I want to talk about foreign exchange. So let's turn the page and sit on a couple of currency pairs for you. Let's pick out 2 of these 3. The euro and sterling. The euro, 111.38, negative 0.1% on the session. The PMI much better than expected, but the heavy lifting came from France. And I'll tell you what I mean by that. The services PMI, this is a preliminary read for the month of August, came in at 55.0. We were looking for 50.3. On the composite, we were looking for a contractionary figure sub 50 of 49.2, and we got 52.7. And because I think in a lot of people's minds, that services read for August was supported by what happened with the Olympics, that's going to fade as the year progresses. So people are discounting the importance of this data this morning, for the euro at least. So we're back down to about 111.39. The same can't be said for what's happening in the UK. Data out of the UK better than expected. Sterling just a little bit stronger, comfortably through 130 now. 130, 117 against the US dollar.
Last time we had strong data in the UK, everyone was just saying it was the Taylor Swift effect, which I don't think there's as much of that anymore, which thank goodness, because I'm tired of central bankers talking about Taylor Swift. It feels very odd and uncomfortable. But also part of it is the dollar has been weakening quite significantly this week. And you've seen some flex of maybe the carry unwind isn't yet over. Sure, dollar versus the yen hasn't moved that much, but dollar Swissy moved some 1%. Peso versus the yen weakened by 2.6% on Tuesday, and then again 1.5% yesterday. George Saravelis at Deutsche Bank points this out, that, say for today, some of the strength in the euro has been, 1, Fed repricing, but 2, something is still going on with this carry trade.
DXY, just to pick up the dollar index, DXY coming off the back of a 4th consecutive day of weakness, a little bit stronger on the session today. If we get a 5th week of weakness, which is what we're on course for, longest weekly losing streak for the dollar going back to April 23. To Danny's point, that dollar weakness is quite pronounced. We've seen it repeatedly over the last few weeks or so. Let's turn to our top stories. Under surveillance this morning, Kamala Harris taking a stage tonight at the DNC, formally accepting the Democratic nomination and delivering a keynote address. Donald Trump countering with a visit to the US-Mexico border and a rally in Arizona. Elsewhere, I want to turn to this story and spend a bit of time on it. A 30-minute delay in releasing the key US payrolls revision wasn't felt by everyone. Bloomberg reporting that Mizuho, BNP Paribas and Nomura all called the Bureau of Labor Statistics and obtained the data directly after it wasn't released as scheduled at 10 a.m. Eastern Time. Now, a good friend of ours, an old colleague, a former colleague, now at BNP Paribas, Yelena Shiletseva, I love this quote. We called the public line a couple of times and they gave us the number. It was that straightforward.
Exactly. And some of the reporting was that the BLS thought that maybe it had published on their website, so we're confused that it didn't, and it was a technical error, so they thought, why not give it to someone on the phone? But listen, government clumsiness is especially a problem when it comes to market-moving data, because you have this appearance of giving people an unfair advantage. You have this appearance of giving people favoritism. So even if, they picked up the phone, Yelena calls, they're like, yeah, of course, we'll give you the data. It's the image that's a problem. And this is why, for example, at Jackson Hole, I didn't realize this, but I learned recently that they don't invite anybody from banks. They don't invite anyone from firms because they don't want to make it look like they're giving people unfair access. It's not necessarily that they are. It's not necessarily that the BLS is, but it is the appearance of that kind of erodes ever so slowly the trust in some of these government organizations.
The effort to avoid that, though, is exactly why we ended up in a place we ended up in yesterday. For people not in the world of the media, typically these numbers used to be given to news organizations under embargo. Then once you got the release time, they were released. Now everyone's just waiting for the same information. Mike McKee sits here literally waiting for the numbers to drop on the website. That's not how we used to do this. I've asked them directly about this in the past. What is going on? What are you willing to do? Because it's not the first time that we've had this issue with delays to releasing the economic data. Really important economic data as well. And I think at some point they've got to do something about it.
And I think especially for the jobs numbers, just because there are a lot of very odd, I will be honest, conspiracy theories out there that made this report so important. Donald Trump was talking about it yesterday. He called it a massive scandal that they revised some of the labor figures, basically claiming that the Obama administration had been massaging things, and this revision was proof as such, which again is weird because presumably if you're going to massage numbers, you're not going to reveal that they were wrong. Even so, these kinds of figures, they're really important, not just for the market, but because, again, of people's trust in these institutions, which has already been worn away. So these types of figures need to be really important. You think they'd kind of give extra care to it and, I don't know, check the website and see that it hadn't published and do something about it?
They seem to be totally unaware. So just dial the number next time. I think we're all going to do the same thing. Let's turn to the main event. The Fed's annual get-together at Jackson Hole kicking off today, with traders awaiting Chairman Powell's remarks tomorrow for some clues about rate cuts as soon as September. More dovish signals came from the Fed minutes, with several officials seeing a plausible case for cutting in July. Another key data point due ahead of Powell's remarks. We'll get jobless claims at 8:30 Eastern Time. How much of a difference do those revisions yesterday make to this Federal Reserve get-together this week and the FOMC meeting next month?
It depends what you already believe, because that's what we did with this revisions data. If you believe that the Fed should be acting sooner, it enforced that the labor market has been weakening for some time. If you don't think so, it enforced, hey, still above 170,000, that is Goldilocks. We are good to just go 25 basis points. Considering the Fed has been talking about moving gradually, they might fall into the latter camp. But again, we learned from the minutes that whether or not they did it at the meeting or afterwards and massaged it, they've now more focused on the risk of the labor market, the risk of not cutting soon enough. So they might be more closely attuned to some of these job figures now.
When you hear that there was a 70,000 per month reduction in average payrolls for the year ending March 2024, it sounds like a heck of a lot of jobs, because it is. When you go through the average print, though, of 170 versus 240, 170 still sounds pretty decent, doesn't it?
It does. Also, one of the weird things with this, 44% of the revisions came from business practices, in other words, consulting. And I just want to know what's going on with these consulting firms. That 44% were professional services. I mean, I know they were firing people. That this seemed especially bad. I don't know. It was a weird revision all around. But that one in particular, I don't know what to do with that information.
There's no conspiracy here. This is a very large economy, and they're very bad at finding out how many jobs we're adding every single month, because it is a very, very big economy. We'll come back to this a little bit later. I want to turn to the autos as well. Ford announcing it's shifting gears in its EV strategy once again, scrapping plans for a fully electric SUV in a shift that could cost the company almost $2 billion. Bloomberg's Craig Trudeau joins us now for more. Craig, great to touch base with you, sir. We've talked about this a million times. What's the latest coming from Ford?
Yeah, speaking of things that keep happening over and over again, Ford itself, it just continues to have sort of pivot after pivot, and I think yesterday's news that they're going to scrap a three-row SUV is really kind of remarkable, because it wasn't that long that we heard from Jim Farley him kind of pointing to this product as, something that was going to distinguish Ford from the pack and separate them from, a Tesla or a BYD. Now that vehicle is going, by the wayside. They're pushing out as well their full-size pickup, their replacement for the F-150 Lightning. That won't come for another year. They already had delayed that product. So, this is a case of a company that's, really been losing quite a bit of money on its investments in electric vehicles, struggling with getting to scale, struggling with high battery costs. And, I think they're really, wanting to kind of recalibrate, get to where, as they're rolling out new models, they have greater confidence in the ability for those vehicles to be profitable within a year of launch, which is the sort of expectation you would, come to think your internal combustion engine vehicles would be able to pull off.
And Craig, that's exactly what Jim Farley told our colleagues about this over and over again. We're waiting for profitability. We need models that can turn out profitability. What needs to be in place for that to happen? And how long might it take until they can see production putting out an EV that does become profitable in a year out?
I think, one of the aspects of this announcement out of Ford is also a change in their battery strategy. So they're really going to lean into onshoring battery sourcing. So, for example, they source some batteries for the Mustang Mach-E, which actually is selling pretty well, but they source those from Poland, and that has hurt their ability to qualify for tax credits in the U.S. And so by moving that production from Poland to the U.S., to Michigan, they'll be able to take advantage of those tax credits, which, with up to $7,500, that's a substantial amount of money for a consumer and going to help their cause. So, in addition to making that change, they are scaling up battery production in other parts of the U.S., and that will help. But this is really a case of also just, having to sort of reassess how ready the consumer is to go fully electric. Ford is having much greater success with, getting the American consumer into a hybrid as opposed to a battery electric vehicle. And so that's another aspect of this announcement that, rather than bringing a fully electric three-row SUV to market, they're going to bring hybrids to market, maybe even an extended range electric vehicle where, the battery does most of the work, but it has a small gas engine to keep that battery charged as it's rolling along.
What does inventory look like at some of these companies, Craig? I'm just thinking about people who might be in the business to buy a new vehicle, an EV, and I cannot think of why they do it. Why they pull the trigger on buying a new vehicle when the improvements we could see over the next few years in battery technology and range could be absolutely massive. Why would you dump a load of cash into a market that's moving this quickly?
I think that's a great question, and I do wonder how much the consumer is necessarily all that sophisticated and following things that closely. But to the extent that the consumer is doing their homework, they're seeing the resale values of EVs go from just a year or two ago. It was very much a success story when we saw Tesla really dramatically bring their prices down because Tesla is still, such a powerhouse in the U.S. market. That's really done a number on resale values. So, the combination of EVs struggling to retain their value, the improvements that we're seeing, to your point, in battery range and costs on a year-to-year basis, it doesn't necessarily make a whole lot of sense if you're a consumer to make that purchase now and maybe put it off, and that's not helping momentum here.
Greg, forgive me for putting you on the spot, but if I drive away from a dealership in a new car, what's the loss look like on day one? What's the fall away look like?
I mean, it kind of depends on the model, of course, but I think this is generally the case with any vehicle where off the lot, the rough approximation of depreciation is, I would say somewhere around 20%. I think with EVs, it's probably more than that at this point.
Brutal. Craig, thank you, sir. Appreciate the update. Craig Trudell there of Bloomberg. The destination hasn't changed. This is where the market's going to go, for now at least. This is where government officials, particularly the Democrats, want the market to go. But the journey's changed markedly over the last year or so.
Yeah, it has. But also part of the problem is not even, do I wait to buy this because the technology is going to get better, but do I need to wait to buy this until there's actual infrastructure in the U.S. that I can go on a road trip and charge one of these things? Which is why you've seen some of these car makers turn more to sort of the hybrid models. But there's still a lot of headwinds to getting adoption. especially when still Ford doesn't have a model they think can be profitable.
And these governments have put these companies in such compromising positions. They want to simultaneously support the workers that work there, and at the same time they've put these companies in a compromising position where they have to move towards making a vehicle that they're struggling to make money on. That's the situation we're in.
Right. And then you have someone like Tesla that gets really reliant on government credit. So that becomes really important for them in order to have a profitability every single earnings quarter. And then you put that into a new administration and what that means for these car makers that previously wanted to double down on EVs. If you need to rely on the government to do that, what happens when there's a change and you get a government less friendly to these types of measures?
Ford is up by about 1/3 of 1% in the pre-market. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hakez.
Hi, John. Sources telling Bloomberg News the head of Apple's App Store, Matt Fisker, who's run the lucrative business since 2010, is leaving in October. Apple's decision comes in response to regulatory pressure on its App Store, with lawmakers alleging it wields too much power in the mobile software market. Meanwhile, shares of Snowflake plunging in the pre-market down more than 9%, the software developer delivering a sales forecast that failed to reassure investors it can gain ground in the market for AI software tools. The company is navigating a challenging environment, including a recent CEO change and security breaches affecting high-profile clients like AT&T and Live Nation. And reports indicate independent Robert F. Kennedy Jr. is expected to end his presidential campaign this week. He plans to give a speech about his future tomorrow from Phoenix, this coming after Kennedy's running mate suggested he could potentially endorse Donald Trump. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, opposing outcomes.
If this is an election about personality, about vibes, Kamala Harris could do very well. If this is an election, on the other hand, about policy, then she's quite vulnerable, and you could see Trump winning.
We'll talk about policy next on the program, live from New York City. You're watching Bloomberg Surveillance. Live from New York City, welcome to the program. Your scores on the S&P 500 shaping up as follows. We are firmer by about 1/10 of 1%, adding to yesterday's gains. As we said a little bit earlier on the program, all-time high on the equal weight S&P 500 at the close yesterday. This morning, the market cap S&P 500 after the close yesterday within 1% of its own all-time high. Under surveillance this morning, opposing outcomes.
The down ballot races, as we've talked about, the composition of Congress, very important to the markets in terms of fiscal policy. Right now, the House looks like it's also a jump ball. If this is an election about personality, about vibes, Kamala Harris could do very well. If this is an election, on the other hand, about policy, then she's quite vulnerable, and you could see Trump winning.
So here's the latest. Opposing economic visions weighing on investor outlooks. Former President Donald Trump proposing steeper tariffs. Vice President Kamala Harris looking to raise the corporate tax rate to 28%. Tom McLoughlin and the team over at UBS writing, if Harris wins but Congress is split, we would expect much more limited policy changes and therefore a more muted impact on financial markets. A Harris administration would be obliged to rely on executive action and regulatory oversight. Tom's with us around the table for more. Tom, good morning.
Good morning. How are you today?
Thanks for joining the program. We're good, and we appreciate your time. So let's get straight to some scenario analysis with you, sir.
Sure.
Are we saying, and just objectively, we can park all the politics, that red sweep would be less bad for markets than, say, blue sweep?
Yes, but one of the things we have to consider is that a lot of this is a tactical response to the market. So over the course of 3 months, we think that's probably true. Over the course of 2 to 3 years, a lot of that does wash out. So for private clients who are basically engaged in a portfolio construction for the long term, we're very cautious about and very consistent in our recommendations that they not go ahead and basically respond abruptly to changes in presidential election results.
Well, let's shift the time horizon from 5 minutes to, say, 18 months and beyond. What are the issues that you're focused on, the policies that you think would complicate things for investors?
So when you look at the two candidates, you can break it out. We get a lot of basically inputs that basically can confuse a lot of voters. When you look at the Trump policies, it's transactional isolationism, wariness of getting involved in foreign entanglements. It's economic populism, lower taxes, lenient regulations. It's border protectionism and trade protectionism. That's the Trump policy. On the other side, from Harris, it's targeted taxation, it's multilateral engagement, and it's social or emphasis on social progressivism and environmental activism. So we actually do have a very clear choice between the two candidates. When it comes to the immediate market reaction, you would expect that Trump victory might be good for financials and energy. It might actually be more difficult for consumer discretionary because Trump is a big fan of tariffs. Tariffs are inflationary. This is not a debatable issue. And as a consequence, you're in a position where it could affect how fast the Fed responds in monetary policy, depending on the results. And a monetary policy is always a slow reactive. I mean, they're always kind of behind the curve. That's not unusual. It's not specific to this environment. We've seen that over the course of 50 years. So when they respond, they're likely to basically take into account the results of the election in December, in January, in February.
If I'm a bond market trader and my number one concern about the outcome of this election is the deficit, what sort of mix would you be most worried about between Congress and the White House?
A unified government under Republican or Democrat, it almost doesn't matter. If your primary concern is the size of the federal deficit, you're actually hoping for a divided Congress because it's going to force a degree of compromise between the two parties. And there's a lot of partisan division in America generally, but also in Congress. When you get a divided Congress, you're in a position where the deficit's going to rise regardless, right? Because when you look at the federal deficit, you've got something on the order of about 75% of the federal deficit is 6 line items: Medicare, federal share of Medicaid, Social Security, defense, veterans benefits, and interest on the national debt. So if you're basically in a position of dealing with the deficit, you've got to deal with entitlements. Neither party wants to do it. So whether the Democrats were to get a unified government or a Republicans were going to get a unified government, the deficit's going to rise faster than if you have a divided government. So that's your number one issue. If the size of the deficit is the principal concern you're focused on, then you're rooting for a divided government.
I just wonder, with a lot of the policies that we're hearing from, a lot of the reaction as to why not actually put it into practice is that there's a difference between what these candidates campaign on and what they realistically will put in place. It's talked that way about Trump's tariffs.
Sure.
Kamala Harris's housing policy has been talked about that way too.
Yeah.
When you talk to clients, do you say you need to take them at face value or discount the policies that they're discussing?
I say take a breath, and here's why. You're in a position where if you go back to 2008, you're seeing a reactive function from those who are disappointed with the results. And when you have a reactive function like that, you go risk off and you miss the rally that follows. So in 2009, beginning in March 9th of 2009, we had an equity rally, right? So anybody who went risk off in response to the 2008 results lost out. And the same thing happened 8 years later in 2016. By those who might have been disappointed in that result, they went risk off and missed the rally in 2017. So you have to take this in the context where, yeah, there's going to be some reactive function in the market, but it's not necessarily going to be so much that you should basically abruptly change your portfolio construction.
Do you think there's a policy proposal out there right now that's slipping under the radar that you think might have some outsized impact that we need to pay more attention to? Can you think of one?
Well, effectively, if you're looking at a Harris presidency, there's not going to be a lot that she's going to be able to get done unless she actually has a unified Congress behind her. So there's going to be more attention in both cases to specific action by the candidates. But here's the interesting, we talked about tariffs before. Tariffs, because of prior legislation passed by Congress, you actually have a fair degree of flexibility for a U.S. president to act on tariffs. And even in a unified kind of government, it's not going to be that much different. But outside of tariffs, it becomes more difficult to go ahead and implement anything dramatic unless you have a unified Congress. And at this point, we think the divided Congress is probably the more likely scenario.
Interesting. Tom, this was great. It's good to catch up. Let's do this again soon. Thank you, sir. Yeah, appreciate your time. Tom McLoughlin there of UBS, just working through some of the scenarios we need to pay attention to going into November.
Yeah, I think the housing proposal is a really interesting one because there are a lot of arguments to say why you shouldn't pay attention to it. That Kamala Harris needs something like a unified government. But still, I think there is merit in taking some of these seriously, and especially like housing where you really whip up demand by giving people support. What happens when lumber's been cheap, so lumber mills have closed down?
I know.
People aren't going to be there to build the housing. So, I mean, it's these government policies that don't have this sort of all-encompassing view that I think worry a lot of people.
I couldn't agree more. The takeaway from this conversation, though, focus on what you can do with executive action, with the expectation being divided government. The next hour of Bloomberg Surveillance shapes up as follows, with Mohamed El-Erian of Queen's College, Cambridge. Evan Roth-Smith of Blueprint will catch up with Matt Hornbach of Morgan Stanley. And Bloomberg's Mike McKee alongside the Kansas City Fed President, Jeff Schmid from Jackson Hole, Wyoming. From New York City, this is Bloomberg.
There's increasing uncertainty at the moment.
There is, I think, some risk in the market just from a valuation standpoint.
What's been most encouraging to me is you've seen resilience and an inflection point in earnings.
This whole narrative that we're slowing down is just not evident in the data.
If you look at valuations, whether it's in the credit markets, whether it's in the equity markets, clearly they are very, very stressed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
August 2nd, 20 days ago. Freaking out about growth scares and all of that. A couple of days later on the Monday, big washout in risk assets driven by that big unwind in the Japanese yen carry trade. Everyone's freaking out, talking about emergency rate cuts from the Federal Reserve, maybe even going 50 before you even make it to Jackson Hole. Here we are 20 days later, within 1% of all-time highs on the S&P 500. Your scores look like this. Equity futures on the S&P positive by 0.1%. The Nasdaq up by 0.2%. Speaking of records, we had another one yesterday on the equal weight S&P 500. It's the rest of the market catching up. The small caps a little bit softer this morning. Big outperformance in yesterday's session. So what's in store this morning? This is what's in store this morning. A little bit later, 7:30 Eastern Time, 30 minutes away, we'll catch up with Bloomberg's Mike McKee, who's just sat down for an interview with the Kansas City Fed President, Mr. Schmid, who's just opened up the annual get-together in Jackson Hole, Wyoming for the Federal Reserve. So look out for those comments in about half an hour from now. Then it's on to jobless claims at 8:30 Eastern Time. Jobless claims at 8:30. Danny Berger in focus in a big way.
It certainly is, because when you think about the mini crisis, the mini panic, the mini freak out, whatever you want to call it, and back to the normal now, there were two really main pillars of what supported us there. One was the jobless claims that showed things weren't deteriorating, and maybe the data we had from payrolls had to do more with weather. The other one was retail. We were concerned about consumer shopping, consumer spending, and the retail earnings have been relatively strong this week. They've showed up, and they've showed an economy that's not falling off the cliff. So now it's that second pillar we turn our attention to make sure that one's still holding in.
The estimate in our survey, 232 for jobless claims. The previous week, 227. Scheduled to drop at 8:30. And if it doesn't come out, just call them directly and they'll give the number to you, apparently based on experience from yesterday. Let's turn to the price action more broadly. Equity futures on the S&P 500 shaping up as follows. We look a little something like this. We're positive by about 0.1%. No drama in the bond market. Yields higher by a couple of basis points, 381.99. The euro shrugging off better than expected PMI data out of the Eurozone, given the Olympic tailwind that France got for their services data. People expect that to fade going into year end. So euro dollar still in and around 111.44. But a big feature of financial markets over the last month or so, dollar weakness, Danny. Dollar weakness has been a big deal for the last 4-5 weeks.
It has, and it gets to this concern of, does the carry trade have further to unwind? I know we spoke about this literally to death after August 5th, but there are still flecks of it in this market. The fact that the dollar weakened 1% versus the Swissy yesterday, the fact that you still see a peso weakening versus the yen, so you have the economic wins behind it. You have a Fed that looks like they're ready to cut, that's more concerned about the labor market, and you still have this buildup of carry trades in the market. So it's this storm that really is weakening the dollar quite significantly.
On the session, just a little bit stronger. Dollar yen just pushing a little bit higher. You can see on the screen, dollar index positive by 0.2%. Here's your lineup this hour. Coming up, Mohamed El-Erian of Queen's College, Cambridge, as Jackson Hole kicks off. Evan Roth-Smith of polling firm Blueprint ahead of Harris's acceptance speech a little bit later this evening. And Matt Hornbach of Morgan Stanley on the odds of a 50 basis point cut in September. We begin with our top story. Stocks on pause with all eyes on Jackson Hole. Traders looking for rate cut clues from Fed Chair Jay Powell when he speaks tomorrow. Mohamed El-Erian of Queen's College, Cambridge, saying the stakes are high, writing in a Bloomberg opinion piece, quote, "It is critical for Powell to take advantage of the golden opportunity he has this Friday to regain control of the economic and policy narrative." Mohamed joins us now for more. Mohamed, good morning. It's good to see you.
Good morning, John. Thanks for having me.
You're with us for the next 90 minutes, so we've got plenty of time to work through these issues. I went through the piece on Bloomberg Opinion, pretty extensive, and a long list of asks for Chairman Powell tomorrow. I'm going to go through another quote that you wrote. It is particularly critical that people come away from Wyoming with a clearer picture of the new equilibrium policy rate that neither restrains nor fuels economic activity, the path to that rate, and what a sustainable 2% inflation target means in practice. Now, that's what you want. Are you expecting to get it this week?
I hope I'll get one of those three, if not two. John, it's critical because, as you and Danny have been discussing this morning, it's not just about price volatility, it's been narrative volatility. People have moved violently in terms of the narrative of the economy, in terms of what the Fed should do, on the basis of high-frequency, noisy data. And that tells you that we're lacking anchors in this economy. We're lacking a robust growth anchor, we're lacking a robust policy forward guidance, and we're lacking a robust technical anchor. So we should hope for the Fed to start restoring the policy anchor. The way you do that is you tell people where you see the destination and how you think you're going to get there. That's what I think he should do. Whether he does or not, I'm not sure.
Well, let's talk about what complicates it. The second anchor, forward guidance. You yourself, this is your language in your piece, you call it an ocean of genuine uncertainty. How do you provide forward guidance in an ocean of genuine uncertainty?
The same way we do everything in life is that you say, this is where I think it is right now. This is where I think our star is, as opposed to saying, I'm not going to talk about it. This is where I think it is. It is dependent on these variables, and I will modify it if a mid-course correction is needed.
Do you think it's important that they discuss how they view the size of cuts, how they view 25 versus 50 basis points?
I think it is important, but there's second-order importance. So the first one is, does the destination look like? And secondly, how are we going to get there? It is problematic in my mind that the market is pricing in so many rate cuts right now. And Danny, you said it right this morning, is that there's this contrast between what the bond market thinks and what the equity market thinks. And this notion, and I love the way both of you have framed it, of a hard landing policy response to achieve a soft landing, that has got to be reconciled one way or the other. So I think the market is overdoing it. I don't think we're going to get 200 basis points of cuts in 12 months. I don't think we're going to get 100 basis points of cuts this year. I think we're going to get 75 and 150 in total. But the market's going to have to adjust at some point to that.
Well, a few people looked at the minutes that were released yesterday and said the fact that several of them discussed cutting in July maybe is them implicitly realizing that they are behind and that they need to be more. Did you come away with that with the same idea?
So when I read the notion that several, not some, several, thought that a July cut was plausible, and I thought to myself, what about the press conference? What happened in the press conference? Why didn't we hear that? And then when I heard both of you discuss the fact that a lot of people are discussing is, are the minutes massaged in some way after the meeting to reflect what has happened since? We won't know until we get the transcripts. Okay, but it is interesting that they put that in the minutes.
Well, there's two options. Either the Fed chair does a lousy job of reflecting consensus in the news conference, or they massage the minutes. You're quite critical, more critical than me, of this Federal Reserve. Poor forecasting, confusing communication, and lapses in bank regulation as well, across those three things. And you think that maybe this could have some really large consequences. There's a quote in this piece that jumped off the page to me, Mohamed. The Fed could further risk damaging its policy effectiveness and reputation, and countries around the world would look for more ways to de-risk both their economies and their financial systems from a Fed that no longer responsibly anchors what is still a dollar-dominated international monetary system. Now, that's not something you just write lighthearted. That's not just you sort of writing that down and expecting us to ignore it. That's important. Do you think that's what's at risk here?
I do, and I really worry about it, John. The US, at the core of the system, has been able to inform and influence outcomes all over the world. And it has been able to lead policy coordination where needed. Why? Because the US was seen to be a responsible steward of the global economy. That started to be undermined in 2008. It was undermined even more in 2017. It's been undermined even more in 2021-22 with the transitory inflation mistake. And what we're seeing are people starting to hedge away from the dollar. Look at the price of gold. Record after record after record. Look at central bank buying of gold around the world. They're diversifying away from the dollar. So I do worry that unless we regain policy credibility, that you're going to start seeing the system fragment, not just for geopolitical reasons, which we know it's fragmenting, but fragmenting because there's less trust in the way the system is managed.
Well, that's what I actually wanted to ask you. You went there exactly where I wanted to go. Is that driven by one half of DC or the other, or both? And how much of it is driven by one and maybe not the other? Because in my mind and other people's minds, they might be listening to this and saying, well, that's about sanctions. That's coming from the government. That's coming from outside of the world of monetary policy. How much of it is about that versus, say, the things we're talking about right now?
We have never seen the amount of volatility in the 2-year that we have seen recently. The 2-year is supposed to be anchored by the Fed forward policy guidance. The longer end can do all sorts of things, but at least you know the 2-year, which the 2 to 5 year, lots and lots of stuff gets priced off that internationally. And it has been a roller coaster. So geopolitics has a big influence, but what we have to minimize is giving another reason for people to diversify away from the system, because they're diversifying not to another system, they're diversifying to fragmentation. They're diversifying to a system that builds little pipes around the center and doesn't solve as well as it should otherwise. And the world will suffer as a result.
The things you're talking about, they are structural changes that central banks are undergoing. And I just wonder if Powell is able to wrestle back control, if government concern doesn't erode it further, can it be undone? Or is this point we're at, has the damage already been done and you basically can't put the paste back in the tube?
So I think the economic side can be undone. You can go back, you can put the paste back into the tube, as you said it. It's a matter of being somewhat less backward-looking and having the courage to be strategic as well. We are excessively data-dependent. In fact, the Fed being excessively data-dependent has led the analyst community to be excessively data-dependent. Look at how probabilities of recession have moved on high-frequency, noisy data. That shouldn't happen. You said earlier, jobless claims has suddenly become this incredible number. Anybody who has been following that series for a long time knows it's incredibly noisy. And yet it can turn markets and it can turn narratives.
Are you confident the Fed will change, though? I mean, the language that we've heard, it still is one of data dependence. It still is one of looking for the next payrolls print to try to get an idea of where they should go. How much confidence do you have that they'll actually adopt what you're recommending?
And the word confidence is so important because it's in every Fed narrative, the word confidence. My confidence is growing. I mean, they are now willing to shift their focus on both elements of their mandate. They're, I think, a little bit worried that the market has forgotten about the inflation part of the mandate. And the market is only worried about the employment part. So I think they're a little bit worried about that, but they're willing to shift their mandate. I think they're going to get that. I think they're getting more confidence now that inflation is below 3% on the CPI. And I know that that's not what they look at, but that's what everybody else looks at. So I think they're gaining more confidence. So I am, too, gaining confidence that they're going to be able to get out of this phase of excessive data dependence that was caused by the big policy mistake in 2021.
We'll come back to that inflation point a little bit later. I'm pleased to say that Mohamed's going to stick with us through the next hour and 15 minutes. Equity futures right now on the S&P 500 positive by 0.2% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira Haquez. Hey, Yahira.
Hi, John. Canada's two biggest railways have shut down after talks with a union failed. Canadian National Railway and Canadian Pacific Kansas City account for almost 80% of the national network. According to Moody's, the lockout could cost Canada up to $341 million per day. More than 9,000 employees are locked out after unsuccessful negotiations over scheduling and worker fatigue. Meanwhile, Vice President Kamala Harris drew more than 2.4 million donors in her first 11 days at the top of the Democratic ticket. That's nearly 200,000 more contributors than during the entirety of President Joe Biden's campaign, which lasted more than a year. The surge in donors resulted in $201 million in individual contributions for her campaign and the Democratic Party, according to the latest Federal Election Commission data. And shares of Peloton are trading higher in the pre-market. The company lowered its outlook and gave a weak forecast for sales and subscription in the current quarter. Peloton has made headway in cutting costs and reducing losses and managed to eke out some revenue growth. This is the first report since Barry McCarthy stepped down as CEO after struggling to return the company to pandemic-era growth. Back to pandemic-era growth. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira again in about 30 minutes' time. Up next on the program, Waltz teeing up Harris.
It's the honor of my life to accept your nomination for Vice President of the United States. Thank you for your passion. Thank you for your determination. And most of all, thank you for bringing the joy to this fight.
We'll head down to Chicago, over to Chicago to catch up with Anne-Marie live from the DNC, from New York City. That's next. This is Bloomberg. Happy to say that Lisa made it safely to Jackson Hole, Wyoming ahead of the annual Fed get-together. She won't be joining us for a few more hours, though, on Bloomberg TV. This is what she sent me last night. Bears in Wyoming are most active during dawn and dusk, especially near water sources. So she's not getting out of bed or leaving her accommodation until the sun is firmly in the sky and it's bright outside.
I want to know what she's going to do about the moose. Aren't they kind of mean and violent too? All those promos we had, just moose everywhere. That's what Jackson Hole looks like.
Not as violent as the grizzlies.
Okay.
I don't think.
Yeah, but grizzlies don't have, scary antlers. They're just claws.
I would be much more scared of a grizzly. That's the latest from Bramo. TK, I'm sure at some point is going to arrive. I've got no idea where Tom is. I'm not responsible for that anymore, but I hope TK gets there safely as well. Equity futures on the S&P 500 firmer by 0.2%. Yields a little bit higher by a couple of basis points on a 10-year, 382.37. Under surveillance this morning, Waltz teeing up Paris.
It's the honor of my life to accept your nomination for Vice President of the United States. We're all here tonight for one beautiful, simple reason. We love this country. Thank you for your passion. Thank you for your determination. And most of all, thank you for bringing the joy to this fight.
So here's the latest. Vice President Kamala Harris taking the stage tonight to give the keynote address of the DNC. Recent momentum has her gaining a narrow lead against Trump in national polls. Evan Roth-Smith of Blueprint writing this: after a summer of high political drama and pageantry, voters are moving back to a preference for substance over flash. Critical voters are going to be won over on bread and butter economic issues, addressing price level concerns and border security. Evan joins us now alongside Bloomberg's Anne-Marie in Chicago. AMH, over to you.
Thanks, Jonathan. That's right. 75 days to go until November 5th. And Evan Roth-Smith joining me here is talking about the fact that after Labor Day, it's really going to be this push towards policy. When can we expect these candidates to really start to outline what they stand for, most notably Kamala Harris, given she's only just got the nomination?
Right. And we're coming out of this summer of pageantry and, high drama, the conventions, the assassination attempt on Trump, the change of candidacy on the Democratic side. And now it's time to settle down into a fall of substance and policy. And Kamala Harris has a lot of work to do to define herself on the economy, a lot of work to do to convince voters that she meets what they want to see out of Democratic policy on inflation and prices at the border. And she's begun to do that. You saw prices highlighted in a big way, and economic concerns, this bread and butter concern for families, working families, highlights from her career as California Attorney General, played again and again in videos and during speeches at the convention, that she took on big companies. And we're going to see that more and more as she defines herself as this champion of working people.
But is she tethered to Bidenomics? Because when you look at polling, Americans blame Biden for things like the high cost of living.
They do, and Biden had these huge trust gaps against Donald Trump on things like handling the economy, things like the price of groceries, interest rates, all of these measures of inflation. But voters didn't and don't associate that with Kamala Harris. She comes in as a relatively clean slate. They don't hang Bidenomics around her neck. Joe Biden kind of takes that off, into the desert with him as he retreats from the national stage. And voters are interested to hear, what does Harris have to say about this? What kind of Democrat is she? Is she, a progressive, a Wall Street Democrat? They don't know. They don't know much about Kamala Harris on economics. They're starting to learn. They're eager to learn. When we test all sorts of facts in our polling around, what would you like to hear most from the Harris campaign, it's almost always some sort of economic policy. And she's been doing that and putting that front and center really well.
But if Trump is still polling better on things like the economy and immigration, how does he land a punch then on Kamala Harris if you're saying she's not tethered to the past 3.5 years under Biden?
Well, he needs to try and tether her, and we're starting to see that the paid media really try and draw a line from point A to point B, being Joe Biden to Kamala Harris. Voters aren't intuitively believing that necessarily. I think they need to see something concrete. And first thing he has to do is Donald Trump needs to win a news cycle for himself. He hasn't been able to do that in a while. Drive a strong narrative for just, own a day the way he used to be able to day after day after day. Because of the Democrats, the drama that has engulfed the ticket, they've had really a whole summer to themselves of headlines and news cycles. First the candidate change, now the convention. And because Donald Trump and the Republicans were riding so high for so long, they kind of squandered a few opportunities to really drive something with the RNC, with the nomination of J.D. Vance. They seemed to be so far ahead, seemed to be doing so well that they didn't feel they had to take advantage of. This has been a criticism of Trump that's been made internally in the Republican Party, that, they were doing so well that he just kind of let it ride. And then a big change happened. Kamala Harris became the nominee. And I think the Republicans wish they had a couple of those moments back, because other than the debate on September 10th, there are going to be very few moments that change the trajectory of this election.
But now you say it's the fall and it's about policy. Do any of these polls matter until after Labor Day?
They do, because with so much change on the ticket, voters just getting to know Kamala Harris, voters just getting to know J.D. Vance on the national stage and Tim Walz on the national stage. These first impressions for these candidates are really important.
Who's doing well in first impressions?
Tim Walz is doing quite well. He, in our latest polling, is plus 10 favorability, so some of these Republican attacks have not dented him. J.D. Vance is minus 21 in our latest favorability polling. That mirrors what some other pollsters are seeing. He has dropped precipitously since his introduction. So we have a 30-point favorability spread between the two vice presidential nominees. And voters aren't going to spend a lot of time thinking about the vice presidential nominees over the next few months. They're going to make their first impression. Okay, J.D. Vance has said quite a few interesting things about women and policies that affect women in his career. Tim Walz seems like a nice guy from the Midwest. The end, back to the top of the ticket.
So the criticism about, him being loose with words about his military record and potentially, the journey his family has taken in terms of fertility, those have not landed.
No, because they don't really connect to anything at the top of the ticket, right? This election is still about the economy. It's still about immigration and border security. It may be about reproductive rights to some extent, although we've yet to see that really break through in salience to the top tier. And J.D. Vance's military service does not help bring down the price. Tim Walz's military service does not help bring down the price of groceries, right? It doesn't affect interest rates. It doesn't affect rents and mortgages, right? It doesn't affect any of that, whether you can buy a car or not. So how much are voters really going to care about what a vice presidential candidate did 15, 20 years ago?
Do you expect any policy tonight, or is it all rhetoric?
I expect to see Kamala Harris take it to the price gougers and take it to corporate America a little bit. I think that is advisable. In our polling, there is enormous pent-up anger at corporate America. And at, whether it's advisable economic policy, I leave to the economists. We've seen quite a few weigh in.
But Trump is able to take that price gouging and say, it's price controls, potentially, when you look at the fact sheet, different than potentially what some of her advisors tell us. But he can say that is communist. Why is that a good policy? Is it just because it polls well?
It polls very well. 81% of Americans support prosecution of price gougers right now. There's so much pent-up anger over inflation and over high price levels that when we've pulled all sorts of potential solutions to see what voters embrace, from things like weekly news conferences, stunty stuff like weekly news conferences to say, here's what we did for you this week on prices, to really aggressive stuff like price controls, like prosecutions of corporate leaders who are found to be price gouging or colluding on prices. And voters want to see something pretty dramatic. They are ready for something pretty dramatic. They do not want to hear tinkering around the margins. Oh, we just need to adjust this tax rate, or we just need to, we have this credit program that they want to hear, I'm going to put the people who've been ripping you off in jail.
Evan, thank you so much for your time. Evan Roth-Smith, their lead pollster at Blueprint. Jonathan, I continuously ask officials surrounding the vice president, can they name a single company that is price gouging? They cannot. But to Evan's point, this polls well. It's a blame game. Don't blame us. It's corporate America.
Yeah, when you find a company, can identify one, let us know. Anne-Marie in Chicago, AMH with the latest. It's ridiculous, isn't it? The things they think that poll well, but ultimately they know in practice the policy is no good.
Right. And again, they have to shift the blame to corporates because they've been the ones in power for the past 4 years. So they kind of need someone to pick out. Even like Kroger, their gross margin hasn't changed. Albertsons, there's none of it.
We'll let Mohamed skip this segment. Coming up next, Michael McKee's interview with Kansas City Fed President Jeff Schmid. Look out for that in just a moment. From New York, you're watching Bloomberg TV. Stocks Stocks riding higher again this morning, up by 0.2% on the S&P 500, up by around about 1/3% on the Nasdaq 100. On the S&P, within 1% of all-time highs at a close yesterday. The S&P 500 gaining for a 9th day in 10. It's been quite a rally. Switch up the board, turn the page, and get into the bond market. Your 2-year yield looks like this, up by 3 basis points on a session, 396.35 going into jobless claims later on this morning. Looking for a number in and around 230, similar to the number we got last week. Remember, jobless claims has contributed to the calm of the last few weeks since that job scare of August 2nd. Claims have come all the way back in. And I want to turn to foreign exchange. Some better data out of the Eurozone and the United Kingdom. The pound holding on to the gains, though, and I'll give you the why in just a moment. 131.14 on sterling, not holding on to the gains in Europe, doing the heavy lifting, the French PMI, off the back of the Olympics, and most people assuming that tailwind is obviously going to fade as the year progresses. Euro dollar 111.35, we're negative by 1/10 of 1%. Let's get you some top stories under surveillance this morning. Bank of Japan Governor Ueda facing scrutiny from lawmakers. He's scheduled to answer questions in Parliament tomorrow after his hawkish signals contributed to a meltdown in global financial markets earlier this month. Mohamed, we've been looking forward to your thoughts on the BOJ as well as the Federal Reserve. How much of the moves we saw at the start of the month were about this story coming out of Japan?
I think they weren't to the extent that people think, because if you remember, the move started on the Thursday, then the Friday. It was really what triggered by U.S. data. Having said that, when the deputy governor came out on the Tuesday and completely changed the narrative, his objective was to press the pause button. His objective was not to press the rewind button. He didn't want to see more trades put on. He wanted just to pause the situation, calm it down, and then continue on the path of normalizing interest rates. So it'll be really interesting to see whether the governor tries to get back to the pause from the rewind or not.
Do you sense we are reloading those trades? Do you sense that maybe we're still vulnerable to this story out of Tokyo?
So the signals are really confusing, John. If you talk to some bankers, they say absolutely. They say we've seen hedge fund put it back on. If you look at how the peso has been behaving, the Mexican peso, it suggests the opposite. So we don't know. We simply don't know. And similarly, we don't know what the size of the trade is. So there are a lot of question marks out there.
It was very big, and we suppose it's still quite big. Something like that, sort of holding your finger up and trying to work it out, aren't we?
Yeah, and that's hard because, remember, technicals are really important.
We'll talk about a word, vulnerability, a little bit more. I want to talk about that word on a different story. The vulnerability around trade. US shippers bracing for the impact of a near total rail shutdown in Canada as 9,000 workers go on strike. The dispute has already begun to affect the movement of products including wheat, chemicals and fertilizers as logistics companies divert cargo to ports south of the border. And we know that ports, particularly on the West Coast, Danny, we've seen the traffic really build up over the last few weeks.
Huge volumes, something akin to what they were like in the pandemic era when you did have these bottleneck effects. And it's this bullwhip that I think everyone still has the trauma of from COVID, of how quickly things can change. And the fact that all these ports all of a sudden are seeing these huge volumes. It's one, concerns about the strikes like that in Canada, and two, concerns about tariffs. So they're front loading all the supply coming in. What if demand starts to weaken? What if they have all of the supply and the picture changes and consumers aren't still spending? You could get a bullwhip effect. And I think that's what everyone is so fearful of, because we had that, not exactly, but still a bullwhip effect during COVID that altered our supply chain and caused inflation.
What do you think the biggest risk is here? A re-acceleration in inflation or a disinflationary bust with oversupply and demand falling off? What's the risk here?
Or both. So-called stagflation, right? So you have three possible scenarios. Look, first of all, I think this is a reminder that the supply side is not as agile as it used to be. And we're seeing different things happen both domestically and globally that confirm that we have to focus on the supply side. I think that's really important. For companies, Danny, inventory management is really hard because it impacts your prices, it impacts all sorts of things. So the companies will not be very excited about what's going on right now. John, I don't know. I think the Fed is right in saying the market has shifted way too much to the employment part of the mandate. It must also look at the inflation part of the mandate. And that's why when you listed out the three things I would like to hear more from Powell on, the third one is, what does sustainable 2% mean? When does it mean? Because that's really important. If you continue having issues on the supply side, getting to 2% means you may risk demand.
Governor Bowman doesn't think it's sustainable. Maybe, perhaps. I don't want to put words in her mouth. I'm just going off the back of some of her recent comments. The risks, at least, coming from Governor Bowman, I list them as follows. Increased geopolitical tensions, additional fiscal stimulus, increased demand for housing due to immigration, the upside risk to inflation. You've been talking about this for a while. You asked the question of Chairman Powell, but I think you have your own answer. You don't think we can get back to 2% sustainably, given some of these factors. Is that fair?
Yeah, I think if you were to set the inflation target today, and you didn't have the legacy of the big 2021 mistake, you would say around 2.5%. This is what you would say, around 2.5%. And it will be 2.5 to 3, and that is consistent with anchored inflationary expectations, which is critical. That is the objective, by the way. The number is irrelevant. What's critical is, do you get anchored inflation expectations? And I think that is what it would be today. But how you make that transition, the way I would do it is by simply pushing out 2%. Saying we're going to get there over the medium term.
They've been doing that for a number of years. High expectations for Chairman Powell then at the Fed's annual get-together in Jackson Hole, which kicks off today with all eyes on the chairman ahead of his remarks tomorrow. The Kansas City Fed President, Jeffrey Schmid, saying he wants to see more economic data before supporting any decision to begin cutting interest rates. He spoke with Bloomberg's Michael McKee just yesterday.
I think it makes sense for me to really look at some of the data that comes in the next few weeks, and I think this mandate on the inflation side is really important. I think we seem to be getting some really good movement that direction. But before we act, at least before I act or recommend acting, I think we need to see a little bit more.
Well, are we essentially on the path to it? In other words, if we get, as predicted, inflation numbers, jobs numbers in the next month, would you agree it's time?
You know, I like the word path, and I also believe that we've seen some cooling in the labor market that also kind of works in tandem a little bit with that. Not exactly sure I would go there just yet. I think it kind of is the nature of what happened with the inflation numbers and how much of those inflation numbers were kind of supply driven that got cured, and then how much is the policy restrictive? And I think while it's restrictive, I don't know if it's overly restrictive. So, for me, policy implies patience, and I would say let's be patient.
Well, what are you worried about? What would be the scenario that would drive inflation back up again?
So if we get any kind of spark in demand, I mean, I go around the 10th district quite a bit. We still have employment numbers, unemployment numbers in the 2.5%, 3.5% range. I think a lot of people are looking at how do we hire skilled labor over the next 12 months. So I still think we could see a little bit of demand pickup if we're not careful with the decisioning. At least from the 10th District standpoint. I'm a big fan of the Beige Book. I try to understand what's happening in 10th District and then try to see what's happening regionally with the other 11 banks. And I think from a trend standpoint, things look pretty good, but I still think we have some time.
I'll let you tell me what you thought of the report that the Bureau of Labor Statistics put out at 818,000 fewer jobs over the 12 months to the first quarter of this year.
Yeah. So the first thing that comes to mind is why are we getting the data wrong in that regard? The second is if you look at it seems like a large number until you put it in perspective of the 12 months. So, while it's a big number, it doesn't really change the path of the way I think of things when I think about monetary policy and the effect of the labor force and what's going on. I'm actually really interested in the dynamics of the labor force, really coming out of the pandemic, the behaviors, the compensation structures, the demographics. I think studying those relative to the future labor force, maybe thinking a little bit about what generative AI does to things like productivity. I think those are important things to look at. Now, we have to look at some of the data relative to what we do with policy in the labor force, but the recent print here isn't a big concern for me.
So you wouldn't agree with the argument that some make on Wall Street that the Fed is behind the curve?
No, I don't really agree with that. I mean, I here again, I think we've got to get as a Fed better at the data sets that we're using. I'm a new central banker. I'd like to see us move toward a more real-time data set versus there still seems to be some lags, some serious lags in some of the data that we get. So using new technologies, maybe some of the AI technologies, maybe we get better data as we move forward, but we've got to really focus on that with our economists and our analysts about, where's the data coming from and can we rely on it?
Mike McKee with the Kansas City Fed President Jeff Schmid speaking ahead of the big Jackson Hole get-together. Mike McKee joins us now for more. Mike, I think it's worth pointing out that the unemployment rate in Wyoming has a 2 handle. It still has a 2 handle just south of 3%. And I wonder, Michael, when you hear comments like that, is he speaking for his district or is he speaking for the country?
I think he was largely speaking for his district, and he was making the point that the 10th district has a very strong economy at this point, and that CEOs of companies in this district are telling him they still see demand, and they still see demand growing. They don't see a huge slowdown, something of a slowdown, but that's one reason that he is still reluctant somewhat on inflation. I think he'll go along if they decide in September, but he sees enough demand that companies are telling him that if they had to, they could raise prices.
Mike, I was really interested. I mean, he said, quote, before we act, at least before I act or recommend acting, I think we need to see a little bit more. So he must be one who weren't in the vast majority of people who want a cut in September. Are you surprised by that?
No, I'm not surprised, and he did confirm that he was not part of the vast majority. But this seat and this district have always been inflation-focused, whether it was the prior president, Esther George, or before him, Tom Honig. They've always looked at inflation as the bigger problem than employment, and so it doesn't surprise me that he takes that view, especially since he's hearing all these reports that demand is still strong in his district.
Mike, one of the interesting things I thought he said, it's a little bit off topic, but he talks about how much of the inflation numbers were kind of supply driven that got cured. And he used that as a way to say maybe policy isn't over restricted because the reason inflation is coming down is because of supply issues that have more normalized. Mike, in order for the Fed to make this argument, is this not them essentially arguing that they didn't have a hand in inflation coming down, that actually the work isn't due to them, that the market, the supply market, did all the work for them?
I think it's a combination, Danny. They do admit that the economy has improved and inflation has come down because of the passage of time and the fact that supply chains have normalized. However, they do think at this point that the last mile and the final percentage points we come down on inflation is due to the fact that they are finally seeing the tightness in the economy have an effect. And we've certainly seen it in the housing market. We've seen it in autos. The interest rate sensitive sectors that normally react quickly to the Fed are now reacting. So they anticipate that they'll be able to get there to 2% and that it's because policy is tight enough.
So Mike, take it one step further. He also said that there were real lags in the data we use, quote unquote, and also said we've got to get better at the data set we have. So do you think that's part of the transition away from overly historical data to more current data and perhaps even a more forward-looking Fed?
I think I don't want to say that they'll necessarily be forward-looking in the sense that they'll move back to the old preemptive stance they took under Greenspan, but they are constantly talking to me, at least to me, about the fact that they're always in conversation with businesses in their district and citizens in their district because they want to know what's happening right now and they recognize the limits of the data that are backward-looking. Now, there's a lot, as you know, Mohamed, of real-time data being produced these days by private vendors, and the government statistics offices are starting to blend those in, and so are the Fed. They get some direct feeds of some of these numbers that we report. They get the raw numbers and they crunch them in their own way to try to get the most up-to-date data possible. But of course, it's by nature backward-looking, so they need these other conversations to give them a full picture of where the economy is at the moment.
Mike, looking forward to your coverage with the rest of the gang. TK and Bramo coming up a little bit later on Bloomberg TV. Michael, thank you, sir. Mohamed, let's get into some of this. If unanimity is important to Fed Chair Jay Powell, there's a few people out there that I think are hesitant to go 25, never mind 50. Doesn't 50 feel like a much higher bar given what we've heard over the last few days?
It does to me, John. It really does. And I don't think the Fed wants to start a cutting cycle with 50. I'm surprised that so many people think it's not such a high bar. For me, it is a high bar. You would need a terrible employment report or something else to happen, an exogenous shock of some sort to get 50.
Keeps coming back to September 6th and that payrolls report. The estimate in our survey right now, we've only got 4 estimates in it, but the median at the moment is about 155k. So we'll see how that evolves in the next couple of weeks. I want to get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. TD Bank missed analyst estimates as wealth management results underperformed expectations with a surge in insurance claims tied to extreme weather. The results adding to the firm's troubles as it booked a new $2.6 billion provision for fines tied to U.S. money laundering investigations. The bank has also been cutting jobs and real estate expenses, partly to counter higher spending on compliance controls, and said its restructuring program is now complete. Shares are lower 4%. Walt Disney has appointed former Morgan Stanley CEO James Gorman to lead the search for a successor to CEO Bob Iger. Gorman joined Disney's board this year and oversaw succession at Morgan Stanley, where he continues to serve as executive chairman. Disney is weighing both internal and external candidates to succeed Iger. His second term as CEO runs through 2026. And Crayola has been issued a patent for the unique scent of its crayons by the U.S. Patent and Trademark Office. Crayola first applied for the trademark back in 2018 and was initially turned down, but has now won its bid on appeal. CEO Pete Ruggiero has said he imagines pumping the smell into store aisles to trigger nostalgia and hopefully making shoppers buy more crayons. That's your Bloomberg Brief. John?
I mean, it's nostalgic. I don't know if it's going to make me buy crayons, but it's certainly nostalgic.
If it's Scratch and Sniff, maybe.
Yeah, if it's what?
Scratch and Sniff, you know, the one you scratch, they smell nice.
Yeah.
I'll buy them. Yeah.
You'd buy some of them?
For the nostalgia, why not?
Okay, I'm not sure that's going to make him enough money. Anyway, up next on the programme, debating how big the Fed goes.
The bar for starting with a 50 basis point cut in September is actually pretty low. I think the issue is it's just been multiple months now where the unemployment rate has been rising. The risks are just really quickly shifting to the labor market. It's not necessarily a mistake, it's just shifting priorities pretty quickly.
We'll talk about those priorities and the size of a potential rate cut in the month of September. Up next, Mohamed's still with us. We'll catch up with Matt Hornbach of Morgan Stanley. From New York, this is Bloomberg. Stocks on the S&P 500 firmer here by 0.2% in the bond market. Yields continue to drift a little bit higher, up by 3 basis points, 383.31. In foreign exchange, euro dollar 111.36. We're negative by 1/10%. PMI's better out of Europe, but not convincing given the tailwind we got from the Olympics for France and the belief that a lot of that won't carry over after the summer's finished. So 111.36 is where the euro is. Under surveillance this morning, debating how big the Fed goes.
The bar for starting with a 50 basis point cut in September is actually pretty low. I think the issue is it's just been multiple months now where the unemployment rate has been rising. I think 50 could even still be considered somewhat gradual. I mean, rates are really high here. We do have them going to 50s, but then slowing to 25s. I think they're obviously, still focused on the inflation side of things, but the risks are just really quickly shifting to the labor market. It's not necessarily a mistake, it's just shifting priorities pretty quickly.
So here's the latest. Traders boosting their bets on a September rate cut after dovish Fed minutes. The next data point coming out at 8:30 with the latest round of jobless claims. Matt Hornbach of Morgan Stanley with this to say. In the eyes of investors, the inflation data leaves the 25 basis point versus 50 basis point decision in the hands of the labour market. FOMC participants may not want to start the easing cycle with a 50 basis point rate cut. Investors may fear a recession. Matt joins us now for more. Matt, it's great to have you with us.
Pleasure to be here.
How high is that bar for 50 versus 25?
Well, I think for the September meeting, it's quite high. I don't think that this committee wants to admit in a way that they were late to the game again. I don't think this is really what they're interested in communicating. They also don't want us talking about a recession. Right? They haven't wanted us talking about inflation for 18 months. They certainly don't want us talking about a recession today. And so I think they're ultimately going to deliver that 25 basis point rate cut in September.
Matt, I agree with you, but talk a little bit of what happens afterwards. Do you agree with what's priced into markets right now?
Well, I do think that the risk is towards larger rate cuts than smaller rate cuts because the data is slowing. That's undeniable. I think that the question really is, how fast is it slowing? That's the debate in the market. The data have not been conclusive on that. And so that's where investors are questioning themselves. How quickly are we slowing?
So I noticed you were very careful, said 50 no to begin with, implying that 50 later is a possibility. Is that where you are?
Well, it's absolutely a possibility. I mean, the data that is slowing is coming in all different shapes and sizes. And this is the problem with the economic data that we get today. We've had this large downward revision in the preliminary benchmark data that we got yesterday. The data that we get every month gets revised lower consistently. And so we just don't know when this will stop. And I think markets will have to take that into account when they're trying to price the average policy path going forward.
And now they have something like 200 basis points worth of cuts over the next year. When you look at 200 basis points, does that say to you this is a market pricing in recession? Or is it, to your point, just trying to get ahead of slowing that's already happening, but not recession?
So this market is pricing the Fed to return to a neutral stance for monetary policy. That is not consistent with a recession. It's just not. You'd have to take the policy rate below neutral to even start really talking about a recession. Because you're going, in the event of a recession, which of course is always a possibility, you will need to have accommodative monetary policy from the Federal Reserve sooner rather than later.
So, okay, if we do get 50 basis points of cuts, how does the Fed massage that message? That this is just about getting back to neutral? This isn't, we know something you don't know and the economy is worse than it is.
Well, I think they're not going to be able to message that, which is why we don't think that they're going to be delivering 50 basis point rate cuts in this cycle. But for the market price, which is what I'm most concerned about as an investment strategist, I have to think about the risks, the primary risks around that baseline view. And given how the data has been behaving of late, the risks are clearly skewed to the downside.
How have your views evolved on the other side of the world, Japan, and how the BOJ factors into some of this too?
Absolutely. Well, the Bank of Japan has a long and sordid history of having bad luck when it comes to raising policy rates. August of 2000, June of 2006, I could go on. I mean, it's just...
Is this another one?
Quite possibly another series of bad luck for the Bank of Japan.
Do you think they can deliver another rate hike?
We do think that they're going to deliver another rate hike in the first quarter of next year. That's where our Japan economist Yamaguchi-san is on the Bank of Japan. It seems very plausible to us that they continue to gradually raise the policy rate.
So when John started with the other side, I thought he was going to go to the inflation side of the Fed's mandate and ask the question, has the market swung too far? Are we so focused on the employment part of the mandate that we've forgotten about the inflation part of the mandate, whereas the Fed is still thinking of the inflation part of the mandate?
Yes, absolutely. I mean, if we want to focus on the inflation part of the mandate and we look at what markets are pricing for inflation, you start to grow more concerned because the markets are pricing inflation to go well below 2%. And if we look at the trajectory of our forecast at Morgan Stanley, we have inflation getting right back down to 2% and then staying there for the foreseeable future. Idealistic, that's what we're forecasting, but clearly here again, the risks are skewed towards lower inflation versus higher inflation. And I, for one, don't believe that a 25 or 50 basis point or even 75 basis points worth of rate cuts this year are going to sow the seeds of a reflationary impulse in the economy. Policy is at least 200, if not 250 or 300 basis points in restrictive territory. How is a 50 basis point rate cut going to reflate this economy? I just don't think that's possible.
Can I jump in quickly? Your 2% forecast, is that a hope cast? Is that like a Federal Reserve kind of thing where they just sort of forecast to because that's where it's meant to be, or that's what you actually believe will end up at?
Well, I think if you look at surveys like the survey of professional forecasters from the Philadelphia Fed, you oftentimes see this sort of, I don't know if I would call it a hope cast. I mean, it's a legitimate forecast, but it ultimately is assuming that central bank policy works, that central banks will be able to achieve their goals in the medium to long term. I think that's a very good assumption.
Matt Hornbach, it's good to see you. Thank you, sir. Matt Hornbach there of Morgan Stanley on the Federal Reserve and the path forward over the next couple of years and how high the bar is for 50 versus 25. The third hour of Bloomberg Surveillance is up next. I'm pleased to say that Mohamed's going to stick with us for the next 35 minutes or so. We'll also catch up with Sam Stovall of CFRA, Democratic Senator Ron Wyden of Oregon, Aditya Bhave of Bank of America and Victoria Fernandez of Crossmark. All of that still to come and more. Equity futures on the S&P 500 about 94 minutes away from the cash open, positive by 0.2%.
This is a market where the growth data is now in the driver's seat.
This is an environment where the Fed can start removing policy restrictiveness.
It could take a long time to get to neutral.
If Godot didn't arrive here over the last really 18, 24 months, why should Godot arrive in August of 2024?
It's never about what the Fed should do, it's what the Fed is going to do.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell from New York City this morning. Good morning, good morning. Your equity market on the S&P 500, positive by 0.2% and getting closer and closer to all-time highs, within 1% of a record high at the close in yesterday's session. This morning, we had some more weight to the rally, up 0.2 on the S&P, on the Nasdaq, up 1/3% on the Russell, up by 0.2. Your day ahead, 30 minutes away. Jobless claims in America, looking for a number close to 230K, which should keep everyone calm out there after seeing a similar number the previous week. All of this as Jackson Hole and the annual Fed get-together kicks off with Chairman Powell's address tomorrow morning. Bramo will bring you coverage through the next 24 hours live on the ground in Jackson Hole, Wyoming. Then later on this evening, you will hear from Kamala Harris in a keynote address at the DNC, and Marie on the ground at the DNC in Chicago. We'll hear from AMH in about 15 minutes' time. We need to talk about how high this bar is for 25 versus 50 on September 18th when the Federal Reserve gets around a table. We're lucky to have Mohamed El-Erian alongside Danny Berger with us for the next 30 minutes or so. Mohamed, it sounds to me like that bar is much higher than people thought a few weeks ago.
That's what I think, but there are people out there who believe it's not that high because they just point in the change in the unemployment rate. So it depends on the set of data you look, and also depends whether you look beyond monetary policy. We must not forget fiscal policy is extremely expansionary, and we talked earlier about supply side issues as well. So the Fed has got to look at the whole set of policies.
We've had you with us for the last 60 minutes. I just get the impression from you that you think we're talking too much about one half of the mandate, and we're maybe neglecting the other half. Is that fair?
Yeah, I think that's fair, and I think we should push back a little bit at this notion that we are overly restrictive looking just at monetary policy. The Fed is going to have to look at the whole demand management side and also take into account supply side.
Sounds to me like Chairman Powell maybe yesterday had an easy job. Speaking to Mohamed, it sounds like he's got a really difficult one. I thought he goes into tomorrow, delivers a speech, basically a subtle evolution of the language you've already heard from the Federal Reserve, tee up September and walk away. Is that not what we're going to get?
I mean, he very well could do that, and he'll upset a lot of people if he does that he's not giving more details. Like you, Mohamed. I mean, you certainly want to hear more than that he just kind of tees up September. There's a long laundry list that you and others have that Powell needs to hit in order to regain control of the market.
Yeah, I suspect he's very tempted to take the minutes, put them in ChatGPT, to summarize them to a 15-minute speech.
Are you suggesting they do that?
No, I'm just saying if you saw the reaction to the minutes and if you've seen how calm markets are right now, that's what you would do. You would simply reinforce what's in the minutes and push back all these other issues.
That address from the Federal Reserve Chairman, 10 a.m. Eastern Time tomorrow morning. Look out for that. Equity futures then positive by 0.2%. A little bit of a lift in this equity market. In the bond market, we look a little something like this, with Treasury yields drifting a little bit higher at the front end of the curve. On a 10-year, we look a little something like this. Yields are higher by 3 basis points, 3.8312. Foreign exchange, euro just a little weaker. Dollar making a comeback here after 4 days of weakness. The dollar just a little bit stronger. Euro dollar 111.35. We're negative by 0.1%. Coming up this hour, we'll catch up with Sam Stovall of CFRA as markets take a breather before Jackson Hole. Aditya Bhave of Bank of America on why the FOMC should move slow and steady. And Victoria Fernandez of Crossmark on why the labour market is the Fed's canary in the coal mine. We begin with a big issue. Stocks on hold as the Fed's annual symposium begins, as investors wait for Chairman Powell's remarks on Friday. Sam Stovall of CFRA saying the following: investors remain ultra vigilant regarding Fed commentary. Fool me once, shame on you. Fool me 5 times, shame on me. September is the 5th FOMC meeting in 2024. A failure to cut would be very disappointing and could trigger another decline. Sam joins us now for more. Sam, I have to say, doesn't it feel like a remote chance, a really, really small probability that they wouldn't cut at all?
I think that would be minuscule, in my opinion. Yeah, it is the 5th time since March. And so if they don't cut, I think investors will be very disappointed. But actually, with the revised employment numbers yesterday, I think that gives additional reason that the Fed will at least cut by 25 basis points.
And that gave more reason for this equity market to rally. Equal weight at all-time highs, small cap outperformings. What do you think equity leadership in the last few days tells you about the attitude of investors towards taking risk appetite more broadly, Sam?
I think in general, that risk is on, that they are feeling more comfortable about being back into equities, because now we're looking at the 155 sub-industries in the S&P 1500 trading above their 50-day, 200-day, and both exceeding long-term averages and much higher than we were only a couple of weeks ago. So I think that investors are basically tiptoeing out onto the ice and saying, feels safe to me.
Is tiptoeing out into the ice the same thing as getting complacent again, Sam?
Good question, Danny. I think that what we will find is that wanting is more motivating than having. Because once the Fed does start to cut interest rates, the market pretty much treads water. It's the sectors, it's the subsurface performance that tends to do very well. And it typically is the interest-sensitive groups that are outperformers, like real estate, like communication services, which was the old telecom going back to the mid-90s, and then also utilities.
Everybody I know would agree with you in saying that it's minuscule probability that they don't cut. Where they disagree is by how much, 25 or 50. Where are you on that?
Good morning, Mohamed. I am on the path of about a 25 basis point cut. I don't think that the Fed wants to emulate the Olympic sprinters and explode out of the blocks by having a 50 basis point cut. I think by cutting 25, they're basically telling the market we are not behind the curve. And that we are going to take a slow and gradual approach. Reason being that they want to continue to ensure that the embers of inflation have been sufficiently doused before they feel that mission accomplished.
Sam, do you think this equity market is priced for a world whereby we don't get the bad data, but we do get the big rate cut?
I think that's an interesting way of putting it, and probably so. When you look at valuations, the S&P is at a 33% premium to its 20-year average forward PE. Technology is in the mid-60% premium. Both of these are down from respective readings of 38% and 78%, but still pretty pricey, and therefore I think expecting a lot of good things to occur with very few bumps along the way.
And one of the other remarkable things that's happened in this market so far in August is the amount of money that's gone into cash. EPFR has it in the first half of the month at almost 90 billion. That would be the highest figure for a half month since November of last year. I thought we were in this period where you look at rates potentially going down, that reinvestment risk gets real. How hard is it to convince people at this moment to not just pour their money into cash?
Well, I think there are two things you could take from that. First off, is all of that cash really going to be going back into equities if they felt more confident about doing so? And I still think that a lot of people just feel comfortable having cash on the sidelines. I think also that with the Fed funds rate still being very attractive, money market rates being very attractive, exceedingly so relative to intermediate and longer term bonds, that investors are taking sort of the short route at this point. Also, we've had two declines of 5% or more, 5.5% that started back in April, 8.5% that started July 31. And so I think investors are like seismologists, and they believe that maybe this seismic activity implies that something a little more volatile might be down the pike. So I think investors are still just playing it close to the vest, because the longer that the Fed does wait to cut rates, the higher the risk of recession.
Sam, got to leave it there. Thank you, sir. Sam Stovall there, CFRA. September 18th, 25 or 50. Andrew Honhorst and the team over at Citi just publishing. They say this: downward jobs revisions lower the bar for a 50 basis point cut. They reflect on the revisions we got yesterday, and they said this: less important than the backward revision is the current establishment payrolls data is likely upwardly biased. We expect the Fed will continue to put increased emphasis on the unemployment rate, making a 50 basis point cut in September more likely. Downward revisions lower the bar for a 50 basis point cut. How important do you think those downward revisions were yesterday?
Not as important as that suggests. In fact,
Why?
because you can argue either side of it. You can argue it's a demand side issue, and therefore it does support a cut. We can argue it's a supply side issue, and therefore the Fed has to be more cautious. I think economists do not agree as to what this means, and I think the market did the right thing yesterday by basically ignoring it.
So basically it was 170 versus 240, average payrolls growth every single month in this country for the 12 months through March 2024. When we hear people say, if you get a bad jobs number on September 6th, this Fed will go 50, do we know what a bad number actually is? What is a bad number?
So I think now a bad number has become lower than the consensus forecast.
Just anything, a downside surprise?
Yeah. I think that's what it has become.
So if we get sub 150 September 6th, you think that people start talking more about 50 basis points?
Yeah, and forget about September 6th. Today, if we get a jobless claim of above 260, just watch what's going to happen. And that is how sensitive we are to this high-frequency data.
We're looking for 230, by the way, for jobless claims in about 20 minutes' time. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get over to Yahara Hackers. Hey, Yahara.
Hi, John. Disease detectives are rushing to quell the Mpox contagion in Central Africa. They're finding a newly mutated virus is spreading mostly through sexual contact in the Democratic Republic of Congo's eastern region. But an older strain is spreading from infected wildlife in other areas of the country. A World Health Organization official said understanding transmission patterns is crucial. And at least 3 banks managed to obtain key payroll numbers Wednesday, while the rest of Wall Street was kept waiting for half an hour. A government delay whipsawed markets and caused confusion on trading desks. Bloomberg reporting Mizuho, BNP Paribas, and Nomura called the department and got the number directly. When the data was finally released, it showed payrolls will likely be revised down by 818,000 for the 12 months through March. And shares of Snowflake plunging more than 10% in the pre-market. The software developer delivering a sales forecast that failed to reassure investors it can gain ground in the market for AI software tools. The company is navigating a challenging environment, including a recent CEO change and security breaches affecting high-profile clients like AT&T and Live Nation. That's your Bloomberg Brief. John?
Yahara, thank you. I love Steve Rasciuto over at Mizuho. Old school, picked up the phone. Just picked up the phone and asked for the number. If you've got Gen Z on the team, nothing wrong with Gen Z, of course, but there's no way Gen Z picked up the phone to find out.
Mohamed's saying that they need to text the BLS. Maybe this is what they need to start doing, like on-demand text will tell you what the jobs data is.
Trying to WhatsApp the Bureau of Labor Statistics to try and find out the number. Up next on the programme, the morning calls. Plus, Senator Ron Wyden joins Anne-Marie from the DNC. That conversation just around the corner from New York. This is Bloomberg. The opening bow 1 hour and 15 minutes away. Equities right now positive by 0.2%. Let's take the chance, the opportunity, a few minutes to get you some morning calls. Your first morning call comes from Piper Sandler, upgrading Estee Lauder to overweight. The analyst citing a prudent China outlook, seeing little reason for the bear thesis to play out further. Your second call from Citi, downgrading TJX to neutral, but lifting its price target to 128. The analyst saying the market is now valuing the discount retailer more appropriately and expects TJX to continue beating on sales and on profit. And your third and final call from Telsey Advisory Group, downgrading Urban Outfitters to market perform. Analyst Dana Telsey noting disappointing performance across its brand portfolio, saying Urban's turnaround plan needs more time. That stock is getting absolutely hammered. We're down by more than 13%. So there's some of the single movers for you, with the equity market just about positive on the S&P by 0.2%. 2 main events for you a little bit later. We'll hear from Chairman Powell tomorrow morning in Jackson Hole, Wyoming. But over at the DNC in Chicago, the main event coming this evening with a keynote address from the Vice President, Kamala Harris. At the DNC is Anne-Marie. AMH, good morning.
Good morning, John. And ahead of that keynote address from Kamala Harris, where we know the economy has been the top issue of this election, I'm now joined by the chairman of the Senate Finance Committee, senior senator from Oregon, Senator Ron Wyden. Thank you so much for joining me.
Thanks for having me.
So Your colleague, Senator Mark Warner, called next year 2025 tax Armageddon, and you've been working already on tax issues. Where do you see room for compromise in 2025?
Well, first of all, we showed in 2024 we wanted a bipartisan approach. I put together a bill that had child tax credit and hundreds of thousands of units of housing and help for small business, and senior Republicans just didn't want to do it. I mean, the fact was J.D. Vance wouldn't even show up for work. So we had a bill that was fully paid for, according to the Joint Committee on Taxation. Would have been a big shot in the arm for families. 16 million kids would have been helped, 4 million small businesses, and Republicans were just AWOL.
Well, J.D. Vance was campaigning at the time, and even many Democrats would say this was a show vote. They knew they didn't have the votes yet. Republicans want to wait to 2025. So that's why I think he would say he didn't show up for that vote.
Understand that if he had been there, if he'd shown up, we could have gotten this passed. It would have gone to the president. It would have been a huge shot in the arm to the economy. We're talking about interest rates now. Looks like the Fed is going to lower interest rates. This is something that would really help families, because you got to understand that working families, when they get these kind of breaks, they go out and buy food and clothing and the like. What do the Republicans want to do? They want class war on working people. They want to hit them with tariffs, and tariffs are taxes on them.
Okay, so let's talk about what could potentially be renegotiated for next year. We know Republicans will sign on for an expansion of child tax credits. J.D. Vance, Trump believe in that. But what about the corporate tax rate? Kamala Harris says 28%. Do you think that's the opening salvo?
Let's remember that the Republicans consistently in campaigns talk about things that they are going to say they're interested in for working people, and then they go out and write these bills that are trickle-down economics and give most of the breaks to the well-to-do. Now, let's talk about where we are on things like corporate taxes. I want to make sure that we have a reasonable rate that's going to allow us to compete in tough global markets. We know this is a challenging, economy. This 21%, Donald Trump pulled out of nowhere. Nobody had any discussion about that in the Senate Finance Committee, and I can tell you a lot of my colleagues on both sides of the aisle, including some Republicans, they don't think the 21% fits our definition of a reasonable rate.
So what do you think is reasonable?
I think that Western civilization isn't going to end with Kamala Harris's proposals. We're going to work in the committee to get a reasonable rate, and one that will keep our companies competitive.
Okay, so that sounds to me maybe like 25%, which I've been hearing as something maybe there could be a negotiation around. 25%?
There was a lot of interest in 25% rate tied to increased opportunities to do business in the United States. Look at the big pharmaceutical companies. They generate a lot of their sales in the United States, a lot of senior citizens, and then they go overseas to get a cheap tax break.
Let's talk about American business. Part of Kamala Harris's economic plan has been this idea about price gouging, going after these individuals in the corporate world that are hiking up prices. And many are viewing that as potentially, is this going to usher in price controls? What is your take on this issue? And can you name a company that is currently price gouging?
I'm glad you asked about this, because I think the vice president is moving in the right direction. We believe in markets. I'm the chairman of the Senate Finance Committee. I believe in markets. I believe in marketplace forces. That's always the best way to go. But when markets are breaking down, you need some guardrails. And that is what the vice president, is talking about. Now, I'm going to be going home. I'm going to be flying all night to have town hall meetings in rural Oregon. You know what folks are going to ask me about? They're going to ask me about the biggest grocery merger in American history. Kroger's and Albertsons.
Do you think it should go through?
Well, what I've said is I think we ought to kind of take a time out. I've been part of the effort with Congresswoman Jayapal to say, let's have kind of a recall on this decision for a while and think through how to come up with a fair agreement. But what I can tell you is when milk is $4 a gallon in a lot of places, meat $10 a pound, a lot of people are saying, get us a fair shake. And the concentration and consolidation we've seen in these food markets, I think is what we got to deal with.
But prices have come down. Walgreens, Target, all these places, Walmart slashing their prices. They see higher-end consumers actually trading down to some of their softer prices, and that was welcomed by the White House. Isn't this all caused by inflation, not corporate greed?
Well, certainly we're coming out of COVID. There are a bunch of factors, but what I can tell you, in my state, we're losing choices, for example, even for buying medicine. We have only a couple of big pharmacies now, they consolidate, and that's anti-consumer. I'm a markets-oriented Democrat. I want to come back to that. But I think when markets aren't going very well, we need to have some guardrails and make sure we protect the consumer.
Senator Ron Wyden, thank you so much for your time, for joining Bloomberg TV. Jonathan, of course, he's also the chairman of the Senate Finance Committee. He will be key to next year's 2025 tax fight.
I had no idea the people of Oregon were that interested in antitrust and competitive issues. Anne-Marie, thank you. AMH over in Chicago. That's going to be the number one concern, the Kroger's, Albertson get-together.
I want to know how many people in that district actually even know that that's a thing. I'd be surprised if it was the majority of them.
Trying to get out of this story, aren't they? I'm still looking for some detail. I loved what he said about the corporate tax rate. 21% came from nowhere. So, OK, what would be good? Well, Western civilization doesn't end with 28. So we're benchmarking things to whether it ends Western civilization or not.
Yeah, a problematic benchmark. And maybe you could say like, oh, well, some places in Europe have high taxes, so we can do it too, and they survive. I mean, what is the bar for this? It's a little bit alarming.
At least we're opening the debate and having a bit more of a conversation about actual policy. Mohamed's with us for a final word. Not on this, certainly, but on corporate issues and what's happening with economic data. I want to reflect and take a step back on some of the conversations we've had over the last number of months. In fact, the last number of years. We came out of the pandemic and you were looking for this inflation to remain higher for a whole lot longer than even the Federal Reserve was. And your North Star, so to speak, on your dashboard was corporate commentary. You were hearing from them repeatedly saying the same thing. It shaped your views, and it certainly shaped your views more recently as well when you talked about corporations warning about a slowdown. What's the signal you take from things now?
It's become more ambiguous, John, and it's fascinating because at a time when the people who look at the world from a top-down perspective have shifted to concern about unemployment, recession, the companies have become less uniform in signaling what's happening to demand. So we have seen Walmart, we have seen Target, we've seen some others say, you know what, it's fine. As long as you cut prices, you can sustain demand. So the big question out there is, are they looking at compositional issues? Are they benefiting from people coming to them and away from others? Or are they looking at an absolute issue? And that's something certainly that I and I suspect others will be looking at very carefully.
What are some of the signals you've gotten, and especially as to whether this is about strategy and who's executing strategy, or a consumer that is weakening, and part of how that's manifesting is they're just being more discriminating in what they buy?
So Dan, you're absolutely right. Strategy is really important, and these are companies that execute strategy really well. You've seen Macy's on the other side that doesn't do that very well. But it's also interesting to hear Target, for example, say people are buying new things. They're buying more clothes than they have before. So maybe it's a shift of consumer from one type of retailer to another. I just think that this is something that people don't look at. I was very intrigued, as you know, John, by what the new president of the Kansas City Fed said when he said we need better data. We need to look at real-time data. We need to look at data that is actually capturing how things are happening. And I think corporations do a great job of giving us that data.
You've wanted to see some dissent at the Federal Reserve, or at least you think dissent is healthy, as experienced by the Bank of England. Are we starting to see some signs of that slowly start to emerge on the committee?
We see it slowly emerging, then it disappears at a meeting. I would love to see the transparency that the Bank of England has. In the last meeting, it was 5-4, 4 against. There was even one meeting where you had 6-1. You had people all over. And I think it's important because it helps people understand how delicate the judgments in play are.
Yeah. I remember a series of decisions a long time ago when Governor King was still at the Bank of England, and they voted against Governor King. I think he wanted to expand QE at the time, but going back a long time, but they were voting against him. This is something you never see at the Federal Reserve.
Right, but also that split is a way to also transmit policy too. Because we have to wait for the meeting minutes to say that they were considering July. If we got the vote split, they could have done it just in that way.
Well, the minutes, are they an accurate reflection of actually where they were at the time? And that's a problem too. Mohamed, this was wonderful. Thanks for your time.
Thanks for having me.
Mohamed El-Erian of Queen's College, Cambridge. A few days after his birthday, he didn't want us to spoil him. Happy birthday, Mohamed, again. It's good to see you. Thank you.
Ouch.
I didn't mention age or anything, did I? People can Google. They can look for that themselves. Jobless claims coming up next from New York. This is Bloomberg. Jobless Claims Thursday is not quite Payrolls Friday, but it's certainly taken on a little bit more weight after the last few weeks, after the scare of August 2nd on payrolls. Jobless claims this morning, the estimate is 232. The previous number is 227. The number drops in about 10 seconds. The score coming into it, they look like this on the S&P 500. Equity futures positive by 0.2%. On the Nasdaq 100, up by 0.33%. With the jobs data, let's get over to Mike McKee for more. Good morning, Mike.
Good morning, John. Well, if you were an economist, I hope you put your money down in Atlantic City or Las Vegas, because the consensus is the number. 232,000 jobless claims. That's up a little bit from 228 last week. It is still a very low number and suggests that the labor market, while it is cooling, is not falling off a cliff. Continuing claims, 1,863,000. That's up from 1,859,000. So a slight rise there. And we've seen that series rise for a little while now, suggesting it's a little harder for people who lose their jobs or who quit their jobs to get new ones, but it is still, again, a low number historically. So no problem with the labor market, and this is one more data point for Jeffrey Schmid to look at as he decides whether he wants to go along with a rate cut or not.
Mike, we had a scare last year as well on jobless claims, and it's worth pointing out the journey of the last 3 weeks, and it's certainly been a journey, all right. It wasn't just the payrolls number on the Friday. The day before, we had jobless claims come in at 250. We had this really weak ISM manufacturing number as well. And all of that, including the employment component of that particular index, Mike, all of that basically got everyone a little bit fearful about where the economy was at. Do you think the data over the last few weeks has put all that to bed? Is it dead and buried? Is that story over?
No, I don't think the story is over, John, and we do have a big employment report coming up for August, the first Friday in September. But right now what we're looking at is a labor market that is pretty much the same as it was in June. In July, we got a lot of auto plants shutting down, so Michigan saw a big rise in jobless claims, and then we had the hurricane in Texas, big rise in jobless claims there that has lasted for a while. And so we had an unusual seasonal problem with the claims numbers in July, and now they seem to have sorted themselves out. We've gotten to the pre-July numbers again, and it just tells you the labor market is status quo. I was talking to some people here yesterday who say basically their reports, and Jeff Schmid was saying the same thing. Their reporting is that companies are not really hiring so much anymore, but they aren't letting anybody go.
Mike, how do you expect these continued strong and not deteriorating labor figures, say for last month, to color what we hear from Fed Chair Powell tomorrow and the rest of the FOMC officials?
Well, they have argued they didn't need to move quickly because the economy was in good shape. And we had a stronger than expected retail sales report. We've had the jobless claims numbers come in low. We anticipate we'll get a rebound in the jobs numbers. And of course, inflation keeps going down. So there's something to their argument that they didn't need to move as quickly as some people on Wall Street wanted them to. And I expect that Powell will not go into that much depth as I just did, but he'll say the economy is strong, and read that as we don't need to move quickly yet, and that may still push them towards the 25 basis point cut in September.
Mike McKee from a beautiful Jackson Hole, Wyoming, as the sun starts to rise. Mike, you enjoy it over there, and looking forward to your conversations throughout today and into tomorrow. Mike McKee there on the latest jobless claims data. If you're just tuning in, welcome to the programme. I'll give you the numbers again. 232 is the number, and that was the estimate as well. So 232 exactly in line with expectations from economists, and just a little bit higher than the previous week, but contained and far, far away from that 250 from a number of weeks ago that started to scare people about where the labour market was heading. So 232 on jobless claims, push it through the equity market. Equity still positive on the S&P 500, up by a few tenths of 1% on the Nasdaq. If you turn a page and switch up the board and get to the bond market, yields a little bit higher at the front end. Just add a little bit more weight to that sell-off in treasuries. Just a bit softer, cheaper this morning. 2-year up by 5 basis points here, Danny. Just getting back close to 4%, which is where we've been pretty well anchored over the last few weeks.
We have. And again, this just kind of confirms this thing that's already been developing in this market, that things aren't falling off a cliff, that equities can continue to climb. But perhaps the best news of all, John, is that no one had to ring up the BLS to get this data.
We actually got it on time.
Yes.
Well said, Danny. And all of this just sort of introducing a little bit more calm going into that address from Chairman Powell tomorrow morning at 10 a.m. Eastern Time. Joining us now to process it all is Aditya Bhave of Bank of America Global Research. Aditya, it's good to see you, sir. Is that exactly what you and the team were looking for?
Thanks for having me. Yeah, this is consistent with our view that the labor market is cooling off, but it isn't outright weak. And the same is the case for the economy. So we're still on the path for a soft landing. The consumer looks solid. Labor market looks good. And that's consistent with the Fed. Yes, they will probably start cutting in September, almost certainly now after the minutes. but there's no need for them, in our view, to start to cut by 50.
Can we reflect on revisions yesterday as well?
Yep.
Quite a steep drop. We've come down from 240 averaging month on month every single month over the last year through March 2024 to about 170.
Yep.
Is 70k a big difference to you? Does that change the story at all?
It is a large downward revision, no doubt, but it's somewhat backward looking, right? So what were we worried about in the last 2 or 3 weeks? We were not worried about January, February, and March. And if you had given us these updated data, we still wouldn't have been worried about that. We were worried about July, and we were worried about April as well, right? So those data haven't been revised. And if you look at claims now, we're hopefully setting up for a slightly better job growth number in August than July.
What about the argument, though, that because these were revised, it means the current numbers we've gotten in the months past are weaker than we thought?
It's possible, but when you get into the weeds, it's not entirely clear that that's the case. So they now update the birth debt model every quarter rather than every year. So maybe those updates have already affected the latest data, and it's not entirely obvious that the latest data will get revised down.
So what degree, then, does this suggest that after the July payrolls print, where we all started freaking out about a growth scare, where we all started worrying about the employment part of the mandate, that maybe we went too far, in concerns of the labor market? Does the recent data make it seem like things aren't as bad as we thought?
Absolutely. And we've been in that camp consistently that, look, we got one bad jobs print, fine, but the economy still looks pretty solid. I mean, look at retail sales over the last 3 months, right? When you're really concerned about a slowdown, what you look for is that simultaneous weakening in consumer spending and the labor market, because they're a little bit chicken and egg. And then retail sales come in May, June, July, basically like Steph Curry in the Olympics, right? Bam, 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 4/10, 9/10, 3/10 on the core control, way above trend, suggesting that things are actually pretty okay.
So walk us through your rate cut path, because we've had people come on the programme and say the Fed's offside by as much as 100 basis points, and that 100 is going to come this year. I know you have a slightly different view, so just explain that view for us for the rate path over at the Fed.
Right, so we have a much shallower path of rate cuts. 25 in September, 25 in December, and then 25 every quarter next year. The idea there, again, is the Fed's gone from a world where they were 100% focused on their inflation mandate to one in which they're balancing the two mandates. The question now is, do they shift to a predominant focus on their labor market mandate? We don't think they're there yet. And we think the inflation data will be sticky enough and the activity data will be resilient enough that they don't need to go that far, which suggests that certainly supersized rate cuts seem unwarranted at this point, by which I mean more than 25 at a meeting. A reasonable alternative scenario to our base case is that they cut at every meeting by 25 for a while. Again, it's not yet our base case, but let's say the jobs come in a little bit softer, but not outright weak. Inflation comes in a little bit softer, then they could shift to that path.
You implied just a little bit where you think inflation might be. Can you put some numbers on it? What's the underlying assumption for CPI in America?
Right, so the underlying assumption is that the core PCE does not get back to 2% until 2026. And yes, you raise your eyebrows, but the entire committee is actually on board with that view.
Okay.
So if you look at the June SEPs, and of course that could change in September, but the June SEP suggests that not a single member on the FOMC had core PCE getting back down to 2% even at the end of next year.
So then that implies, okay, so you have a slower path of cutting than the market implies. It takes a little bit longer to get to 2%.
Yep.
When do they need to get to neutral in this cycle? I know it's this figure that we're struggling to grasp for, but in the grand scheme of this path forward, when makes sense? Because if we keep going 25-25, it takes a while to get there.
Right, so we have the cutting cycle ending in mid-2026 at 3.25 to 3.5%. Now, you can ask whether that's actually neutral. And maybe it isn't, right? Maybe that's still a little bit above neutral. And maybe that is a sensible terminal rate, because the Fed could say, look, we've dealt with an extended period, several years of above trend inflation. And there are some indications that maybe R star has increased as well. And so for both of those reasons, we want to err on the upside. And we want to keep rates a little bit restrictive, keep a little ammunition for when that next recession actually hits. Because when it does, the Fed's going to cut very, very fast, right? We know that from history.
The revisions that you mentioned for the SEP, September 18th, I did raise my eyebrows. You didn't catch that on camera, by the way. I'm just wondering what kind of revisions and how drastic they will be on September 18th compared to where they were back in June. For instance, they've got unemployment at 4% year end, and we're already north of that. What could you expect to see?
Yeah, so there's going to need to be some data points that get marked to market. Unemployment is probably the biggest one. Inflation, probably less so, to be honest, because the big driver of the longer-term inflation outlook is going to be housing. If housing doesn't take that additional step down, the math for 2% core PCE just does not work.
Yep.
So as long as housing's a little bit sticky, and that's what we got in the last report, I think they're comfortable broadly with where their inflation path is right now.
A question that we like to ask at the moment, particularly given that so many of the people that typically watch this programme are still at the beach, do they need to come back to work tomorrow for the Chairman Powell's speech? Will there be any drama? Or is this a drama-free address from the chairman?
I think Chair Powell can give a very clear signal that they'll cut in September. Usually, chairs don't like to front-run the committee at Jackson Hole, but this is not really front-running because it was very clearly telegraphed in the minutes yesterday, right? A vast majority think it's going to be appropriate to cut rates probably in September. So he can give that signal. I don't think it makes any sense whatsoever to talk about 25 or 50 tomorrow because you're waiting for the next jobs report. You're waiting for the next few weeks of claims data.
Very true. Aditya, it's good to see you. Thank you, sir. Aditya Bhave there of Bank of America Global Research. We're waiting for September 6th for payroll, September 11th for CPI, and several weeks of claims data. Claims this morning exactly bang in line with the median estimate in our survey, 232. That's exactly what we got. Equities positive here by 0.1% on the S&P 500. If we can just turn to the bond market, and I'll give you a flavour of things across the curve, but just particularly at the front end of the curve, a little bit of a lift here on a 2-year by about 4 or 5 basis points, approaching 4% again at 397.62. To continue the conversation, Victoria Fernandez of Crossmark Global Investments joins us. Victoria, last time we caught up, you were worried about a slowdown in the second half. Are you seeing evidence of that or evidence to the contrary?
No, I think we're still looking at signs that are telling us a slowdown could be coming. I know that the idea of a recession has really been taken off the table for most people, but I think a slowdown in the economy is there. I mean, look, you've got small caps outperforming large yesterday, but yet 40% of the Russell 2000 hasn't even had a profit. They haven't reported a profit over the last 12 months. You've got the difference between the 2-year and the Fed funds at extreme levels, typically that you only see when you're in a recession. You have saving rates coming down while delinquencies are going up. We know the consumer, even though they're spending, are being very cautious in what they're spending. And I think when we look at the labor market and wages and earnings and margins for corporations, we could see that start to tighten up a little bit. And I think a good sign, you were just talking about the housing market, mortgage rates are down 80 basis points, and we aren't even seeing a bump in the housing market. We've seen refis go up applications, but not home buyers. So I still think there's some struggling going on in this economy, and I think we'll continue to see it in the second half of the year.
Enough of a struggle to validate what's been priced into Federal Reserve rate cut expectations.
Look, the Fed, in my opinion, is going to go very slowly. So your last guest talked about 2 rate cuts this year. That's where we at Crossmark are as well. 25 in September, 25 in December. I don't think they're going to go more than that, which means we may see a little bit of a repricing in the bond market. 2 years, you were just mentioning, are right back up close to 4%. We could see yields start to go back up as some of that is priced out of the market. Some of the cuts people are expecting. I mean, what are they pricing in now? 3.5, 4 cuts. It's similar to what we saw at the beginning of the year when everyone was expecting 5 or 6. They had to come back and reprice the market. So in our fixed income portfolios, we've gone close to neutral duration. We're not ready to go long yet at this point.
Victoria, is a Fed that goes slow with data that's getting weaker but not necessarily weak, is that also consistent with gold priced at $2,500 an ounce?
You know, it's very interesting, Dana, because you're seeing this differentiation coming now between gold and Bitcoin, where they had been going together for quite a long period of time. So I think people are going to gold. You're seeing the dollar come down. I know it had a little bit of a bounce yesterday, but the dollar's down pretty significantly. If the Fed is starting to lower rates, we'll see that happen more. So people going into gold for a safe haven play. And we're seeing a lot of gold buying coming out of Asia as well. So not surprised surprised gold is moving higher. Not surprised we're seeing the dollar come down. I think that fits with the story of a Fed slowly removing some of the tightness that's there. I think one of the things I like to say is the Fed is not really being accommodative over the next few months. I think they're just going to be less restrictive.
I just wonder what you think the success is in doing that, is using gold as a hedge. David Rosenberg at Rosenberg Research thinks it's going to go to 3,000 simply because people don't trust bonds as a hedge right now. They don't trust central bank policy. They don't trust the guidance. So gold is where you hide out. Victoria, gold hasn't had the best track record of being the place that you can hold out over long periods of time. So is it now the time? Can now be the time that you can hold on to gold as something that protects you instead of something like bonds?
So it hurts my heart a little bit, Danny, when you say people don't like bonds, because I do manage taxable fixed income here at Crossmark. So I think you need to have some allocation to bonds in your portfolio. Look, it's a cash flow component, right? So maybe it's not a safe haven in the sense that from the time of purchase to the time of maturity, you don't have market value volatility. You will, but you get a steady cash flow coming from that. Is it okay to have a little bit of gold as a hedge in your portfolio? I think that's fine. Do you do a huge allocation shift to that? I think that's a little much. I don't think there's anything in the economy that's telling us we have to make that drastic of a move.
There is one thing that you've been saying, though, that runs contrary to what we've heard from a lot of people in fixed income. And I understand they've got something to sell, so there is sort of a bias in all of this too. You're still saying that just sit there and earn cash, earn money on cash. Sit there at the front end, take your 5%. Victoria, other people, as you know, are coming on the programme and saying you've got to lock in what's available at the long end right now because that's not going to be there in several months' time. Why is your approach a little bit different?
Well, I think they need to look at it from a barbell approach, Jonathan. I mean, look, yes, you can get some of that locked in on the short end. We know the Fed's going to lower rates. We talked about the difference between the 2-year and the Fed funds being quite extreme. That's going to have to narrow at some point. So do the short end of the curve, do those yields come down? Yes. So you get in now, you get a little bit of price appreciation in that because you will have lower yields going forward. So lock some of that in. But I agree, go out a little bit on the curve. Add some of that on the longer end. If you can still get 4.5%, 5% in quality investment grade, we're talking A, AA rated, not even having to go into BBB rated bonds, go ahead and put that in there as well. Again, it's part of that cash flow story and sets you up, especially if you're trying to match liabilities with the assets in your portfolio. It puts you in a good place over the next 5 to 7 years.
Victoria, I've also got to ask you, because I know you see wages and how it relates to consumption as one of the canaries in the coal mine for this economy. Given that, what did you make of some of these retail earnings we've gotten, the success of a Target and the lack of it for someone like Macy's?
It's an interesting kind of bifurcation that we're seeing. Obviously, Walmart did really well. I think some of the reason you're seeing a name like Walmart do well is because they have captured a much larger audience than they used to have. We know that a lot of high-income spenders have actually moved into Walmart, so they're gaining traction there. Target was interesting. We know that their comps, they have pretty easy comps because they have been underperforming for quite a long period of time. Glad to see them coming back. You're seeing better pricing in some of those elements. I know they said clothing was up, so that's good. And they also had a big boost from e-commerce. So again, different elements that are helping support. But Macy's been struggling for a while. They are that middle income consumer that is really having to pull back on discretionary spending as some of their more non-discretionary items like food continue to move higher. So definitely a bifurcation that we're seeing in retail. Some of your low-cost providers are gaining share and doing better, while that middle-income consumer store is really starting to struggle. It does come down to wages. Wages is the driver of consumption. And I think as we see margins start to compress and earnings start to come down a little bit in the next 6 months or so, we can see wages start to stagnate. That's going to hurt the consumer.
When did you last go to a Macy's, Victoria? How long ago was it?
It's been a while. I will say I've been to Bloomingdale's across the street from you guys, but Macy's, it has been quite a few years since I have stepped foot in a Macy's, and it's probably why they're closing a lot of their stores right now.
Yeah, Bloomingdale's so close you can accidentally fall into it walking down Lexington Avenue. I get it. I get it. It's convenient. Victoria, thank you. Victoria Fernandez of Crossmark Global Investments. I feel the same. It's local. Am I going to make sort of like the trip, though? Like the trip to go there? No.
I like it as sort of a mind cleanse. Sometimes I go there and just smell the candles, and they
I'm
all.
not sure that's why they want you to go in.
No, they get furious because they show me candles and then I walk out and don't buy anything. So I'm probably the worst person that they
Is
could have
that a
there.
thing? People go in there for a mind cleanse? To
No,
smell the smells? Or
I
is
think
that a Danny
that's
Berger thing?
uniquely me and
Okay.
probably reveals more about myself than I'd like to.
Learning things. Thank you, Danny. Futures are up by 0.2. Jobless claims are okay. 232 against an estimate of 232. Bond yields a little bit higher at the front end. The 2-year up by about 4 basis points this morning. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. The Associated Press reporting that the Italian Coast Guard has recovered the body of British tech tycoon Mike Lynch from the scene of a sunken yacht off the coast of Sicily. Bloomberg reporting Italian authorities have recovered at least 5 bodies. Morgan Stanley International Chair Jonathan Bloomer is also feared dead. The yacht was hit by a tornado near Porticello, Italy on Monday. Of the 22 passengers on board, 15 were rescued that same day. Canada's 2 biggest railways have shut down after talks with the union failed. Canadian National Railway and Canadian Pacific Kansas City account for almost 80% of the national network. According to Moody's, the lockout could cost Canada up to $341 million per day. More than 9,000 employees are locked out after unsuccessful negotiations over scheduling and worker fatigue. And BMW is pulling ahead of Tesla in European EV sales for the first time ever. Sales of fully electric BMWs in the bloc jumped by around a third in July, according to data compiled by Jado Dynamics. Meanwhile, Tesla's shipments declined 16%, but Tesla still dominates the region's sales ranking year to date. This all coming as demand for EVs is cooling in Europe after countries including Germany and Sweden pared back or even stopped subsidies altogether, prompting manufacturers to walk back their EV ambitions. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the programme, setting you up for the rest of the week as markets await Fed Chair Jay Powell's Jackson Hole speech. We'll get you some full coverage tomorrow, of course, when we catch up with Lisa and the team on the ground in Jackson Hole, Wyoming. Up next, we'll catch up with Anne-Marie on the ground at the DNC in Chicago. From New York, this is Bloomberg. The opening about 36 minutes away with equity futures positive here by 0.2% as we count you down to that opening bout. The trading diary, the calendar for the week ahead looks like this. At 9:45 Eastern, we get US PMIs and Jackson Hole and the annual Fed get-together kicking off today. Tomorrow, you will hear from the Fed chairman, Jay Powell, delivering his remarks at 10 a.m. Eastern. As we turn to the other main event this week, the DNC concluding tonight with Vice President Kamala Harris formally accepting the Democratic nomination. AMH is on the ground at the DNC in Chicago. Anne-Marie, the main event later this evening. Walk us through the time and the content, the substance, what you'll be focused on.
Well, Jonathan, I think tonight what you can expect is a lot of rhetoric. So far, the DNC, they've been able to pass the torch from Biden to Harris. And now this is Harris's moment to really talk about how she envisions the future, especially if she was going to be in the White House, how she potentially envisions some policy proposals. But maybe she talks about them in a broad way. We're not going to get, I doubt, the very nitty-gritty details that we're all waiting for. But we do know one of her first policy pitches has been leaning into the cost of living.